Neighbors, 70 plus and above, talking to me about how interest rates were at 13% and they survived it. So I should not too worry about my mortgage. But of course, after the big sell-off yesterday, futures a little bit on the higher side, with the next futures gaining 0.8%.
I love that you're polling your 70-year-old neighbours on the question of inflation, but we do need to go back that far to get an accurate reflection of what is happening in these markets. Arguably, JP Morgan, Goldman Sachs joining the likes of Barclays, which was first out of the gate on Friday in terms of starting to factor in 75 basis points. And of course, you had the reporting in the Dow Jones, Bloomberg and elsewhere around the fact that the FOMC and the Fed is very seriously looking at 75 basis points for Wednesday. 200 basis points between now and September is what the money markets are starting to price in. So, of course, adjusting to that. For the moment, the markets are taking a deep breath after those sell-offs that we saw yesterday. Across assets, of course, the S&P fell into a bear market. You saw yields on the US 10-year jumping for 2 days, the highest and the biggest jump that we've seen since 1987. Here at the open, the FTSE 100 gaining 0.6%, of course, within the context of the sell-off that we saw yesterday. The CAC Cahont gaining 0.7%, 45 points. And over in Spain, the IBEX is up 0.7% as well. Let's switch it on and see how things are playing out cross-asset. We're looking at the futures, of course, in the US. The S&P futures, the E-minis pointed to gains of 1.2%. So to some extent making up some of the heavy losses, not fully, but partly making up some of the losses that we saw yesterday. The Chinese session, by the way, on the mainland turned around as well. Sentiment ended more positive on the mainland. The dollar in focus, of course, bid significantly in the last couple of days as part of that safe haven move. Now coming off just a tad, just down 0.2%. It's the Italian 10-year and also the 2-year that we can keep an eye on, of course, as well. But the 10-year was above 4%. To come off that a little bit, 394, yields down 8 basis points just in the session, but within the context that you saw moves of plus 20 basis points in the last few days for Italian debt. And of course, continued concerns about the risks of fragmentation. Bitcoin and crypto, we've seen that market drop below $1 trillion in terms of market cap, 22,616, pairing some of the heavier losses of the session for Bitcoin, down 2.5% as things stand. We continue to watch that as a barometer of risk. Francine?
Yeah, it'll be interesting to see whether the ECB tries to placate some of the risk-on mood on Italian yields, or whether for the moment they just keep mum. This is a picture for sectors. So after the huge sell-off yesterday, we're seeing a bit of a reprieve in terms of the sectors that are gaining the most. First of all of the sectors on the upside. You can see just 5 or 6 stocks actually on the downside. But banks leading the gains, 1.7% higher. Technology, travel and leisure, the biggest gainers. And then amongst the gainers, but that are not gaining as much as the others, we have auto parts and real estate gaining about 0.2%. And as always, Tom, not done on purpose. I feel like I'm matching the color of the markets. Today we're in green.
It's beautifully, beautifully done. From the macro to the micro, some individual corporate stories to bring to your attention. Total Energies making an investment over in India in some green energies alongside Adani, taking a 25% stake in Adani's green energy operations there. The stock is up 1.4%. Morphosis, this is a biopharm company aligning with Pfizer on the trial of a cancer drug, currently up 6.3% on the back of that news. And Air France saying they had a successful rights issue, raising around 2.3 billion euros, down 4.4%. They said they saw strong demand for new and existing investors. Right, let's get over to Bloomberg's MLive managing editor, Mark Cudmore. And Mark, you are assessing the market moves that we've seen over the last 48 hours. Is the relative calm that we're seeing now in these markets, do you think that's going to hold?
Short term, maybe, but overall, I think the moves we have seen will continue. I know Francine's been polling her 70-year-old neighbours on interest rates, and understandably, because really it is all about interest rates at the moment. And I thought I'd just do a chart kind of showing how extreme the moves have been over the past year, and to make the point that even though we're very focused on the Fed this week, and correctly so, about whether they'll do 50 basis points, 75 basis points, or 100 even, it is really a global theme. So the blue line here is the Fed, and you can see that's up at 3.3%, two-year yields. There's two-year yields in markets across the board. The red line is Indonesia. I use that to kind of give an example of emerging markets. That's the dollar-denominated debt in Indonesia. The white line there is Australia, where the RBA were really fighting rate hikes around the world. And we have the UK line as the purple line, up above 2%. And finally, the yellow line, really, really important, is Italy two-year, which was deeply negative as recently as, well, mid-December, really, actually. And so all these markets are up more than about 200 basis points, apart from the UK. There is one really, really large exception, and that is the Bank of Japan. You can see that orange line there. It almost looks like I've drawn a zero line in the chart. It is the only one that's not moving. It's the one that really stands out as the exception, and that's why there's such pressure on the BOJ. We saw record bond purchases today to maintain the yield curve control, and as we heard from a guest in the last hour's show, there is an expectation that at some point the BOJ will have to capitulate on that yield curve control because of the pressure globally. One final theme, I think, is apart from the Bank of Japan, is the fact that in November, every single one of these yields was below 1%. So I think it's about where we've come from is really, really dramatic. And it's the move since then. All of them have done more than 200 basis points since then, apart from the UK. The UK was actually at the higher end of things back in November, and it's really only done about 150 basis points. So apart from Japan, that's another market where I think the fact that we're seeing globally higher yields may force the Bank of England to hike more than is even expected, even though the economy is really, really suffering. Final point, though, I think the dramatic thing is we're still not very high. Francine's polling all her neighbourly pensioners about what it was like when we had double-digit yields back in the 70s. But the fact is, we're talking about these really excited moves, and in many of these markets, yields are pretty close to flat. ECB still has negative rates. Bank of Japan, S&B, all these markets still have negative yields. And even in the countries where we're hiking, we're only talking about getting towards 1%. So I think we have a long way to go before those pensioners' expertise really comes into its own.
Mark, I have to say, it's not so much in polling, because I know that's your expertise in MLive. They drop in for a cup of tea, and then especially Priscilla, 82-year-old former Air Force, says, don't worry, I lived through interest rates at 17%, and I could still afford my mortgage.
Well, I mean, it's good advice, isn't it? It's great to have these important colleagues at this time, Francine. But I'm glad I know in future where you're getting your markets insights, because I have actually wondered how you get these particularly unique insights at times, but now I know.
I'm sure Priscilla would have seen this inflation forecast, because I know she keeps a very close eye on the price, for example, of milk. Our managing editor for MLive, Mark Cudmore. Now, if you look at the markets, and of course the UK cost of living, Tom, squeezing a lot of the households, and to put into context, our Phil Aldrich had this great story in saying, look, inflation is not high enough for consumers, but it's too high for companies. And this is what both the Bank of England and the Prime Minister have to deal with.
Yeah, absolutely. And of course, the Bank of England coming up later this week, and that conundrum very clear cut for the Bank of England is BlackRock's Scott Teal was telling us earlier. That was really for him, the central bank to watch this week, given the recession risks hiking into a recession. But I do think we should get Priscilla on the show to give her analysis now that you've given her a shout out.
I mean, she would come marching. Let's get into the key market drivers with our Eddie van der Walt from our Markets Live team. First of all, I mean, there is a huge concern where we see value in the markets, given all of these interest rates, conundrums, and what this means for risk assets.
You know, I think today is a fantastically interesting day because, of course, we are seeing this pause in the selling. I don't think that means that the market is turning bullish, right? I think there's a lot of people that say, listen, I was selling, but we're getting close to the Fed. I'm just taking some of that aggressive moves off. So what we are getting is a window into where people are picking up value. So when we look at the European Open now, when we see the sectors that are up today, I think that's telling us where people will come in really big on the buy side when they step in back. So I think the session that we're moving into, I think this is absolutely telling for us.
What about Bitcoin?
Oh, Bitcoin's fantastic. You know, I think.
Wait, Bitcoin's fantastic?
No, it's
22,000.
fantastically
Great story.
interesting. Fantastically interesting on the downside. I mean, it's coming back a little bit today, but look, the drawdowns this time around is much bigger than we have seen, you know, in previous cycles. Previous cycles, what we saw was Bitcoin go parabolic. It draws down, stays well above the previous lows. This time, we're getting back to those 2017 peaks and so on, right? So I think not quite existential for Bitcoin, but we are seeing people reassess, because if we go below the highs that we had in 2017 and so on, then, you know, this narrative of as long as you hold Bitcoin for long enough, you make money, that's out the window. So I think this is a real test for cryptocurrencies more broadly, but particularly also for those yield-seeking subcategory of cryptocurrencies.
Eddie, what's happening with commodities?
Look, the commodity sector is holding up fairly well through all of this, and I think that is telling, because I think that shows us that we haven't seen the demand destruction that a lot of people are talking about yet, right? What we're seeing now is a response to the Fed and rates, but we're not seeing worries over demand for oil, demand for copper, demand for those things. So I think what that tells us is that if the Fed slams too hard, there is more downside to be had in wider markets, because we're pricing higher rates. We're not pricing a recession just yet.
Let's get your thoughts on the dollar before we let you go. So the market's pricing in, money markets, 200 basis points from the Fed between now and September. Does that continue to give support to the greenback then?
Look, it's very hard not to be bullish the dollar at this point, right? The dollar is just absolutely, it's benefiting from this haven bid. It's benefiting from yield differentials. Unless we see something extraordinary, like an intermeeting hike at the ECB, which nobody is talking about, I just don't see how you can be short the dollar, you know, in the next few sessions.
Okay, Eddie van der Walt doing a fantastic job as running through some of the key market themes this morning as we digest those significant moves yesterday. Thank you.
Now, coming up, with the U.S. continuing to surprise to the upside, we also discuss all of the possible options on the table for the Fed next with Bill Street from Quintet Private Bank. This is Bloomberg.
The Indian city of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani. His company Reliance has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the Indian government's plan to reach net zero emissions by 2070. But Ambani is not alone. India's second richest man, Gautam Adani, has committed $20 billion of investment over the next decade. But India's massive dependencies on fossil fuels have some environmental advocates questioning the realism and sincerity of those green ambitions and those of its two biggest billionaires.
This week is fraught with peril.
Inflation is really the Achilles heel of risk markets.
Markets are reacting the way they are because they believe the Fed is going to be forced to get more aggressive than they had expected.
I certainly don't think that a 75 basis point hike is out of the question.
Even though there might be an initial sell-off on 100 basis points, I think there'd be a subsequent rally because the Fed is finally getting hold of the narrative, which it certainly has lost over the last year.
This is a time to be selective, but I wouldn't sit on my hands.
There are opportunities in areas where one can position.
Pockets of stocks that have been proven.
Europe looks good to us. China looks good to us. The credit space in the U.S. looks good to us.
Equities in general, specifically in the U.S., I'm still pretty cautious here.
It doesn't have to be all about the U.S.
Because I still think we've got some wood to chop with respect to the macro and policy outlook.
A number of guests there on Bloomberg TV weighing in on the market sell-off. Now, let's bring in Quintet Private Banks Europe Chief Investment Officer Bill Street. Bill, great to speak to you. I mean, I have to say, I still have to meet a market person that says, look, just sell everything and go home because that's how they make their money. So you could see pockets of growth, but how much more of a correction could we see?
Well, we're definitely closer to the bottom than we were a few days ago. That's for sure. And look, when you look at recession and these types of corrections, you're looking at the sort of 25 to 30% sort of downdraft. I mean, this is sort of a new paradigm to a certain extent, or this sort of turning over of growth and inflation. Yep. But look, as long-term investors, we're here to try and find value in our portfolios. Yep. And this is actually quite an interesting time. It's a very anxious time. It's going to be a long, hot summer. But, you know, our view on inflation is turning over. And if the Fed manages this very sort of nimble path, which is a pretty blunt instrument of policy, we could have a relatively constructive back end to the year.
Okay, that's a big if. Money market's pricing in 200 basis points between now and September. Would that give you the confidence that they are getting a grip on inflation, or would it flag for you the risk of a policy mistake?
So we're definitely sort of tiptoeing this policy mistake tightrope. But really, when it comes to central bank policy, it's as much about what the Fed says more than what it does. Now, whether they do 50 or 75 this Friday and how they take the sort of liquidity out of the system by September, and they've got this big gap in the summer in August, is really how they're messaging the markets. I mean, we're in the camp that actually we're at peak inflation at this point. I mean, mechanically, inflation will come down relatively significantly between the summer and the end of the year, just looking at the dynamics of the energy market.
But Bill, what happens if inflation actually stays elevated for a number of structural factors? If, for example, China reopens, they're going to also demand a lot more oil and energy. And if we are at inflation at these kind of levels and we start pricing in a recession, what happens to markets?
Yeah, so look, we're not expecting, so hopefully China does open up. I mean, that's going to be good for growth and it's going to be good for the dynamics of the global economy. But look, oil price only needs to stay where it is for the next few months for having a significant deflationary impact into the headline inflation. So in terms of maintaining the inflation number where it is, the oil price would have to accelerate to about $200 a barrel. If it stays where the futures market is expecting it to stay, roughly around the 115 and 125 level, we're going to have inflation closer to zero on energy by the end of the year. Now, energy makes up about 25 to 30% of headline inflation. So you can see how inflation will start suppressing in the back end of the year, Q3, Q4. And that's what the juggling act the Fed are trying to do. We've gone past peak growth in this cycle, and what they should be doing is trying to moderate the sort of growth cycle and looking through this inflation number, which goes to the point. It's really about what they say rather than what they do for the confidence.
How much granularity do you have to put when you're looking at household balance sheets across the different spectrums, whether it's kind of the low end to the high end, the resilience of the high end? You're seeing that in luxury, for example, at the moment. Do you see that persisting, and how is that informing your investment decisions when it comes to the consumer?
So the consumer, I mean, the biggest consumer is obviously the US. And the US, one of the good things, positives in this environment is actually the economies, the G10 economies are generally coming from a relatively strong base in terms of the sort of macro. And the US consumer is still pretty strong. And the US consumer unemployment rates, they're still spending, consumer balance sheets are pretty strong. So
we got the Michigan survey on Friday. Fell to a record low in terms of consumer sentiment.
Yeah, and that's a sentiment perspective.
Right.
And sentiment can change, and that again goes back to the Fed. It's what they say rather than what they do. The balance sheets and the sort of individuals' balance sheets are actually quite strong, and employment is actually pretty resilient at the moment, and earnings are pretty good, positive. So it's really a sentiment question.
I'm actually amazed at how optimistic you are, given the day we had yesterday and the kind of the longer-term outlook we have for, in general, spending for the U.S. consumer in the UK.
So look, it is going to be a difficult summer. I mean, this is it. I mean, we're sort of constructive at the back end of the year, and we're cautiously constructive. But this is really predicated on...
So that means you're not panicking?
Yeah, exactly. Well, we're long-term investors, so we're looking at opportunities and value in the markets in our portfolios. And this is really, this is actually, for investors who've got dry powder, there's some significant opportunity out there.
Okay, cautiously constructive. We'll get more of your calls after the break. Quintet Private Banks Europe CIO Bill Street staying with us. Let's get the Bloomberg Business Flash now with Angel Feliciano. Angel.
Tom, 2 giant Wall Street banks are said to be withdrawing from handling trades of Russian debt. That's in response to the Biden administration's surprise announcement last week that it's banning U.S. investors from scooping up such assets. Bloomberg has learned that J.P. Morgan Chase and Goldman Sachs were still matching sellers who wanted out of the debts with interested buyers this month. The U.S. Treasury's Office of Foreign Assets Control has said investors in the U.S. aren't allowed to acquire them. Bloomberg's been told that Elon Musk will address and take questions from Twitter employees at a virtual meeting on Thursday. It's the first company-wide gathering since he agreed in late April to buy the company for $44 billion. Many Twitter workers are unhappy with Musk, who has been openly critical of the company, its products, and its policies. Sources tell us a joint venture between Paramount Global and Reliance Industries has snatched online streaming rights to the Indian Premier League cricket. The result is a blow to Disney's streaming ambitions, with the sports scene as a big contributor to global growth. After a bidding war, Disney did secure broadcast rights for TV. Each deal is said to be worth up to $3 billion, according to media reports. And that is your Bloomberg Business Flash. Tom, Francine.
Angel, thanks so much. Angel Feliciano here in London. Coming up, more on the markets as global stocks sink into bear market territory and bonds plunge. This is Bloomberg.
Happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management. It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
they've already said, 50 in June, 50 in July. Given how bad the announcement was Friday, I think what Chairman Powell can do is bring that 50 forward. Even though there might be an initial sell-off on 100 basis points, I think there'd be a subsequent rally because the Fed is finally getting hold of the narrative, which it certainly has lost over the last year.
Wharton School Finance's Professor Jeremy Siegel there calling for a 100 basis point Fed rate hike and suggesting that on the back of that you could see a market rally. Quintet Private Bank's Europe CIO Bill Street is still with us. We want to unpack your constructive view, cautiously constructive view on these markets. And you say of growth, this is an investor opportunity of the decade, that it is misunderstood. Just unpack that for us.
Yeah, I think what we're seeing is this, and it's been reported at length, this sort of rotation between growth and value. And it's at those sort of rotation differentials are at sort of 20-year extremes, okay? But it's not just about the growth versus value rotation. Growth has been hit because interest rates are going up because of the inflation story. So growth stocks seem to represent the duration element of the stock market, and that's why they've been re-rated. But if you look at the growth stocks, there's a huge amount of very high quality growth stocks have been sort of babies being thrown out with the bathwater to a certain extent. So you've had re-ratings of very strong growth stocks with very strong balance sheets, whilst their earnings are still stable or growing. So when I talk about growth, or when we talk about growth, we're looking at quality growth stocks, those with really strong balance sheets, low debt to EBITDA, or high gross margins.
And literally, are there like 5 names?
Well, I mean, anecdotally, for example, you can find names in some of the tech stocks or some of the internet stocks. But for example, just anecdotally, Microsoft, for example, is very strong balance sheet, very low debt to EBITDA, very large gross margins. And gross margins means pricing power. So some of these companies are actually going to benefit from the inflation narrative as well.
Do you get in now, or do you wait? Is there a risk of catching a falling knife?
So this is my point on cautiously constructive, and the point that it is going to be a little bit of a long, hot summer. But this is the period where we're getting sort of feedback from investors with dry powder, is how do we feed into the marketplace? But if you just pull up a fairly simple earnings chart versus a price chart on a stock, the differentials are huge.
Will we see European and actually Italian yields blow out unless the ECB addresses it?
Yeah, so look, as an investor, we also need to look at those sort of orthogonal shocks into your portfolio. The biggest issue or anxiety as I wake up this morning, as we've been highlighting for a few weeks, is the ECB and the ECB bond, or the European bond market, in particular, what's happening in the BTP and in the Italian space. This is an underrated risk in the marketplace. We've seen this play before. Yeah. We've got the biggest buyer of these bonds stepping away, and you see the velocity of those prices are scary.
Yeah, you really look at that and you say this is the risk of fragmentation. Quintet Private Bank's Europe Chief Investment Officer Bill Street, thank you. Coming up, but we'll have plenty more, of course, on the UK. We'll look also at the Northern Ireland Protocol. This is Bloomberg.
That it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccines specifically, neutralize the virus, but not as efficiently, because various studies showing that reduction up to 40-fold, meaning that a 3rd dose is a must. for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines, and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done uses a small sample number, and most of the time when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Welcome back to the Open, everyone. 30 minutes into the European trading day, and here are your top stories. Nowhere to hide. Stocks sink in the bear market, but the rout hits pause in Europe today. Treasury yields surge as Italian BTPs top 4%. Did somebody say 100? Well, markets start pricing in even more dramatic hikes by the Fed. JP Morgan sees a 75 basis point hike, but describes a full point hike as a non-trivial risk. Plus, it's Brexit crunch time again. Boris Johnson sparks another rift with the EU, laying out a plan to override the Northern Ireland Protocol. So, Tom, if you look at the markets, interesting to have Bill Street talk about Italian BTP. So they briefly touched that yield 4%. They're just below 4%. But again, the risk of fragmentation seems to be clearer every day unless the ECB acts.
Bill Street saying that is the thing that keeps him up at night, the concern around the European peripheral. And whether we get more then from the ECB in terms of clarification from Christine Lagarde, you're right. The top 4% in terms of the BTPs. There is a move, though, into sovereign debt in the last few hours. You're watching that, so yields coming off the BTP 10 years. Also a move into US Treasuries across the curve as well. Yields coming down as investors just weigh up whether or not and how hard and how fast the Federal Reserve will go. JP Morgan joining the likes of Goldman Sachs, predicting 75 basis points, 200 basis points in terms of the money market pricing for the Federal Reserve between now and September. But choppiness certainly in these bond markets, a little bit marginal, very marginal relief across the equity markets, gains of a little over 0.1% across the benchmark. The DAX is high by 0.2%, and the FTSE 100 as well, up 14 points, 7,220 on the FTSE 100. We look ahead to the Bank of England, of course. We had the Fed first, then the Bank of England at a time, of course, when you could be looking to hike into essentially recessionary environment here in the UK. Banks gaining 1.4%, energy also up, Brent gaining about 1%, telecoms and financial services also in the green. A number of stocks and sectors still in the red, including auto parts, consumer parts of the business as well, sector instead, real estate as well. In terms of oil, we do have the OPEC report out later today. The IEA in terms of demand and supply, looking ahead to 2023, that is out Wednesday as well. Francine.
Now, the EU's chief Brexit negotiator, Maros Sefcovic, has warned that the UK will not renegotiate the Northern Ireland Protocol. He also says the bloc is weighing its legal options after London presented a bill to override parts of the Brexit agreement. Now, for more on this, we're joined by Lizzie Burden. Our European correspondent, Maria Tadeo, is also in Brussels. Lizzie, first of all, what does the bill seek to do?
So the UK's proposal is to split the flow of goods going between Britain and Northern Ireland off from goods that are continuing into the EU. And the UK government says that's necessary because the Democratic Unionist Party in Northern Ireland is refusing to join the power-sharing executive there until the Northern Ireland protocols change. But the irony is that the DUP is still refusing to commit to join the power-sharing executive. In terms of the legality, there were concerns about that. The UK says that this is legal because of the doctrine of necessity, which essentially says the Northern Ireland Protocol is so broken it has to be fixed. And the Foreign Secretary, Liz Truss, was speaking this morning. She says that the reason the UK isn't reaching for Article 16 and blowing up the Brexit deal is because they don't want to continue with the status quo. They want to make change so that it works. But Boris Johnson's likely to face opposition in both the Commons and the Lords on this, so it could take at least a year before this bill comes to pass.
Maria, let's get the European reaction then. What have we been hearing from Brussels around the UK's attempts to rewrite a deal that they and that the British Parliament ultimately voted on?
And Tom, here we go again. Once again, this is the debate, and this is whether or not, of course, the European Union now follows through on that warning that we had yesterday, potentially could see tariffs and a trade war between the two sides. Now, with the European Union, the initial reaction here, of course, is essentially what you'd expect from the Commission. Unilateral moves are not something that works. The protocol is the only solution, and the European Union will not be forced into a renegotiation it does not believe in. I think for the time being, that reaction was calm, muted. The European Union says, of course, they will stick together as EU27 on this. But I think today, this is when it gets tricky, because it's the European civil servants that will now look at the detail of this bill. And depending on that, on how serious they believe this is a violation, we could see the European Union escalate. What I would say and note, however, and this I hear all the time repeatedly when I speak to sources and contacts, is that the timing of this for the European public opinion is not something that will play well. For the Europeans, this is still a story about the war in Ukraine. That is a big geopolitical headache. Also, when you look at the economic repercussions of this, inflation, the cost of living, there's other issues, of course, that for the European Union really come as a top priority. This would not seem one.
Thank you so much, Lizzie Bird and Maria Tadeo. They're, of course, looking at the various angles of the story. Now, we're now joined by the Northern Ireland's Agriculture Minister and former leader of the pro-union DUP, Edwin Poots. Mr. Poots, thank you for joining us. Do you think this deal, or certainly this bill, goes far enough in addressing the problems that you perceived in the Northern Ireland Protocol?
The bill makes substantial change to the circumstances that we currently find ourselves in. And just to set out the circumstances that we are in, we find that 75% of our imported food comes from Great Britain to Northern Ireland, and the EU wants every mouthful of food that people will eat to go through expensive checks. That has a consequence for the people of Northern Ireland in driving up their cost of living. It's causing real, meaningful and tangible harm to the people of Northern Ireland, and is only being reduced by the current grace periods that exist that the EU won't get.
Minister,
So in terms of what is being proposed, yes, it does deal with those things.
Yeah, so you think it goes enough in addressing all of your concerns?
It makes a significant imprint on addressing our concerns, but it is only a proposal and it's not legislation until it's passed.
Okay, does it mean then that the DUP will rejoin the National Assembly?
Well, it's certainly something that we have to give due consideration to, and we will look at how things transpire in the second stage of the reading. So obviously the first reading of a bill, there isn't much happens. The second reading shows the colour of the money, in that people walk through the lobbies and demonstrate that they're committed to actually ensuring that this bill happens, and therefore, we will take further judgments as and when we see progress on this issue.
Okay. The majority of people, polling suggests the majority of people in Northern Ireland do not support rewriting the Northern Ireland Protocol. And the European Union, of course, are suggesting there will be retaliation. Do you just override those concerns, sir?
Well, you see, this takes us back to the Belfast Good Friday Agreement, in that we were to place in minority protections. So what was built in for the Good Friday Agreement in 1998 remains important today. And we need to ensure that the constitutional change that happened as a consequence of the withdrawal agreement is dealt with and is amended. And again, this piece of work will help do that. In terms of the European Union, if you look at the situation whenever they went to ban oil from Russia, that was vetoed by Hungary. And I think that particularly the Eastern European Union countries recognise the friend that they have in the United Kingdom, the work that the United Kingdom is doing in Ukraine. What the United Kingdom is doing in Ukraine is far and above what most of the other European countries are doing in supporting the Ukrainian war effort.
Minister, the DUP supported Brexit. You knew this was an eventuality. The Europeans came forward. They told you that this was what was going to happen.
No, that's absolute nonsense. Brexit and the protocol are two different issues in this respect. We are all for protecting the European Union single market, but stopping food coming into Northern Ireland or ensuring that all of that food has checks taking place is entirely unnecessary to protect the European Union single market. What the European Union have done has been grossly unfair, very damaging to Northern Ireland, and were it not for the grace periods that were brought in, again, I suppose illegally by the United Kingdom government, were it not for those grace periods, we would be feeling real punishment this time as a consequence of European Union actions. And I don't understand why the European Union is so against the peace process in Northern Ireland and why it's acting in the way that it is, because it is damaging relations here in Northern Ireland. And we should be working and progressing through the various crises that we have at the minute and not be having to constantly deal with this issue because the European Union has been so stubborn.
I mean, I think there was an understanding that the protocol was signed by both agreements, but I want to go back a little bit to, you said, we'll reserve judgment when the DUP, of course, goes back to power sharing in Stormont. So is the legislation enough?
The legislation in itself deals with many of the issues that we have been raising. So we need to see the colour of the money in terms of getting the legislation through. The second stage of the reading of that legislation is critically important. And we need to have a demonstration that that will go through Parliament with relative ease, because we understand that there may be issues at the House of Lords stage. Parliament Act can, of course, overrule the House of Lords. So we want to see just at the second stage what's going on, and we will take further decisions at that point.
Okay, the business community, we've had discussions with manufacturers in Northern Ireland. They suggest that they support the protocol, and indeed farmers, the farming lobby, support the Northern Ireland Protocol as well, with some changes. What do you say to businesses as you push for this change that could lead to a trade war with the European Union?
Well, it depends. If you have chosen businesses, they will say that. But the vast majority of people are finding that there's significant problems. So, for example, Marks and Spencer's indicated that their cost of taking food to Ireland in the last year was £30 million of additional cost. Now, ultimately, a company's not going to absorb that forever. They're going to pass that on to consumers. The hauliers are saying their costs are up by 34%, purely down to the protocol issues, and that's going to be passed on to businesses. I've been talking to many businesses who have difficulty acquiring goods that previously were easy to acquire. The costs, the paperwork, many of them have taken on additional staff just to cover that. So this is not a good picture for business as things stand. I believe that much of what is being proposed here will actually help business, will help address the issues. And yes, we will have one or two sectors who are out shouting loudly at the minute, but that is not reflective of everybody.
Okay, Minister, we appreciate your time this morning. Northern Ireland Agriculture Minister and former leader of the pro-union DUP, Edwin Potts. Thank you for joining us. Right, coming up, more on the global stocks sell-off. We speak to London Technology Club CEO Konstantin Sidorov about the tech sector and how it navigates a higher rates environment. This is Bloomberg.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
Welcome back to the Open, everyone. 44 minutes into the European trading day. Yesterday, we went through a huge wrap. Look at that. A little bit of maybe stock picking, or certainly stocks in Europe rebounding. Futures in the U.S. also pointing to a higher open. Treasury snapping a 4-day sell-off. Sentiment steady. I'm not sure it's getting that much better, but at least for the moment, it's a bit more stable than it was yesterday, Tom.
Yeah, stable and steady. Global stocks are sinking, or have sunk, as Francine was saying. Now they are stabilizing, of course, on these concerns that the Federal Reserve is going to have to hike much faster than many had anticipated. 200 basis points is what the money markets are pricing in. 75 basis points for Wednesday, according to JP Morgan, Goldman Sachs. Barclays, of course, first out the gate on Friday with that call. What happens to tech then within that environment? For more on this and where the opportunities lie in a higher rates environment for tech, let's bring in London Technology Club CEO Konstantin Sidorov, who joins us in the studio. Wonderful to see you here this Tuesday morning in the studio. Let's start with that question then. In a higher rates environment, what happens to technology? Financial conditions are becoming tighter. How is that impacting the tech sector?
First of all, thank you for inviting me. And very important to separate the wheat from the chaff. So we have a lot of quality stock in tech, and we believe in this stock. And our task as the advisor, as the London Technology Club, to advise our investors how to separate it.
Okay, you have investments in Lyft, Spotify, Revolut, Klarna, Airbnb, Didi over in China, the ride-hailing app. What are you doing in terms of what are valuations looking like, and how much of an opportunity does it open up for you? That founders now have fewer opportunities in terms of funding. You have the financing, and you can go and snap up companies, or at least you can invest at a lower valuation.
First of all, there is a difference between private stock and the public stock. And we see a big correction in the public stock, but to be honest, we don't see a big correction in private market yet. So we will have that in the coming quarters, but still, we have just a few signs of that.
But there's inflation, there's supply chain concerns for the tech. I mean, it's also a nightmare, I guess, for everyone, right? So are you finding investment opportunities right now, and for what companies?
Again, there are so many good companies now with a very, very good balance sheet, with great liquidity, with great growth.
In what space?
Oh, in many spaces. You know, I believe in market heroes, and you can find those companies in almost every segment.
So, I mean, I know you like fintech, for example. Talk to us about the need for these companies to show that they are profitable, because they are under scrutiny. We're seeing the sell-off. They're under pressure, the publicly listed companies. Do they need to show that they're profitable before you take a punt on them?
Not. I don't think so. I think still the growth is very important factor, and market share, because technology still is the key point for the profitability of other sectors. It's a key point for efficiency. And even in this market situation over the traditional sectors, many traditional companies are looking for improve their efficiency. And technology is exactly the sector which could help them to do so. So in terms of the fundamental points, in terms of fundamental positioning of the technology companies, nothing changed.
Because, Constant, is there a specific part of technology? I mean, we were looking at augmented reality, we were looking at like voice recognition, data analysis. There's so much. I mean, technology is so wide. I feel like I live through technology, period. Is there a part of technology that you like more than others?
I really like AI. Okay. You mentioned it. So that's because AI is the sector behind of any other technologies. If we look at fintech companies, the best fintech, the best healthcare, the best autonomous companies. So AI is behind. So I'm a big believer in it.
What are you saying to your founders who you've invested in? Because Sequoia came out and said you need to start tightening your belts, maybe even cutting costs, like rethinking hiring plans. Are you having those conversations with your founders?
Of course, investors are very cautious right now. They prefer to sit on the cash and wait for better time. But the best investors believe that, smart investors, believe that the best time to invest during at the bottom during downturn. And this proved to be the best investing strategy.
But the founders of these companies, do you expect to see heavy job cuts across the tech sector as they readjust to this environment?
Some of them, yes, because many companies tried to decrease their cash burn and prolong the period until the next rounds. So to go to the next round and at the end of this year or 2023. So we see that a lot.
Thank you so much. Of course, London Technology Club CEO there, Konstantin Sidorov, joining us with a nice roundup of some of the tech opportunities out there.
Yep, still opportunities even within this high rates environment. Let's get to the Bloomberg First Word News now with Angel Feliciano. Angel.
Tom, the UK has unveiled legislation to override parts of its Brexit deal with the European Union. The move risks a trade war with the EU, which has threatened to take legal action. If passed, the bill would give the UK the power to unilaterally rewrite the bulk of the Northern Ireland Protocol, which kept the region in the EU single market after Brexit. Beijing has reported the highest number of daily COVID cases in 3 weeks, as officials call for the city to do more to curb the pandemic. 74 infections were reported for Monday. That's the most since May 22, when the capital had a record number for the current outbreak. The nation's top official for pandemic control, Vice Premier Sun Chunlan, last night urged Beijing to control the outbreak as soon as possible. Emergency crews from California to New Mexico have been battling wildfires that have forced hundreds of people to leave their homes. The fires, such as this one in Arizona, have been driven by high winds that have grounded aircraft that would have been used to fight the blazes. The number of square miles burned so far this year is more than double the 10-year U.S. national average. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Francine, Tom.
Angel, thank you so much. Angel Feliciano in London. Now, coming up, we'll be speaking to the Hong Kong Chief Executive, Carrie Lam, later on this morning, as she prepares to move on from the role at the end of the month. This is Bloomberg.
Global news 24 hours.
prices and a short supply of key chemicals that produce synthetic fertilisers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertiliser helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down. The manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
We're unlikely at this stage to go into a deep or long recession. It's possible we go into a recession, obviously. Probably 50-50 odds now. But that's okay.
Well, that was Morgan Stanley Chief Executive Officer James Gorman saying he sees a 50% risk of a U.S. recession. Now, the market's a lot more stable, a lot more quiet than they were yesterday, where we saw a pretty crazy day, repricing also the S&P in a bear market territory. The one piece of anxiousness that we really see out there, and it was interesting to speak to Bill Street, was what exactly is happening on the Italian 10-year yield, above 4%, now at 3.97. The market's again testing the resolve of the ECB maybe to show the markets what tool they have to deal with fragmentation.
Yeah, concerns about fragmentation, as you say. Some money moving into Italian debt, but of course not making up for the losses that we've seen in the last few days. As you say, 397 on the Italian BTP. We do know that the spread BTPs over German bonds remains elevated, of course, and our previous guest, Bill Street from Quintet, saying this is something that keeps him up at night. You're also seeing money moving in. It's like, take a deep breath until the next CPI print, basically. Some money moving in to US Treasuries rail across the curve. That yield inversion that you saw between the 2s and 10s, not there anymore, at least for now. The 2s seeing a yield drop around 8 basis points, and the 10s down by 6 basis points, 3.29 for your 10-year yield, Francine.
Yeah, and then of course we need to look at sterling. Certainly UK real wages posted their biggest drop in 2 decades. Now, which is interesting for this, if you look at the inflation and how that progresses, that it's not actually enough for workers to be able to live better than they did just a year ago. But for companies, it's still quite a big inflationary pressure. So it's in this no man's land where it's worse for both parties, and you don't know how the Bank of England will deal with that.
And of course, Bank of England is coming up latest this week, and the conundrum could not be more clear-cut for the central bank, of course, on concerns that the UK is heading to recession, and of course that need to address that very high inflation here in the UK as well. Plenty more coming up. That is it for the European Market Open. Surveillance Early Edition is up next. Stay with us. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
They've already said, 50 in June, 50 in July.
From our perspective, the markets are performing incredibly well. There's a ton of liquidity in the market.
It's possible we go into recession, obviously. Probably 50-50 odds now, but that's okay.
Even though there might be an initial sell-off on 100 basis points, I think there'd be a subsequent rally because the Fed is finally getting hold of the narrative.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Good morning, everyone, and welcome to Bloomberg Surveillance Early Edition on this Tuesday, the 14th of June. I'm Francine Lacqua here in London, and here's what's coming up on today's program. Stocks rebound in Europe along with U.S. equity futures as a sell-off takes a breather. Markets await the next data point. PPI drops at 1:30 UK time. The 100 basis point question. Now markets start pricing in even more dramatic hikes by the Fed. JP Morgan sees 75 basis points, but describes a full point hike as an untrivial risk. And dip buyers rush back into crypto. Bitcoin pairs a plunge of 10%, but still trades lower than at any point since December 2020. So let's get straight to the markets. Yesterday's market moves were so extreme that for some traders, it actually evoked memories of the Lehman Brothers blow-up. Now, first, Asian stocks market sold off, but that negativity really rolled on around the world, sending the S&P 500 into a bear market and wiping $1.3 trillion off equities. Now, other risk assets sold off, with cryptocurrencies, for example, plummeting so violently that a popular lending platform froze withdrawals to prevent a very modern kind of bank run. Meanwhile, the dollar index roared to the highest level in almost 2 decades. Now, short-dated U.S. yields jumped by so much that the 2-10 spreads, of course, the curve inverted for the second time this year. The last time yields moved so fast in 2 days was back in 2008. And here's how some of the guests on Bloomberg TV reacted to that sell-off.
This week is fraught with peril. Inflation is really the Achilles heel of risk markets.
Markets are reacting the way they are because they believe the Fed is going to be forced to get more aggressive than they had expected.
I certainly don't think that a 75 basis point hike is out of the question.
Even though there might be an initial sell-off on 100 basis points, I think there'd be a subsequent rally because the Fed is finally getting hold of the narrative, which it certainly has lost over the last year.
This is a time to be selective, but I wouldn't sit on my hands.
There are opportunities in areas where one can position.
Pockets of stocks that have been proven.
Europe looks good to us. China looks good to us. The credit space in the U.S. looks good to us.
Equities in general, specifically in the U.S., I'm still pretty cautious here.
It doesn't have to be all about the U.S.
Because I still think we've got some wood to chop with respect to the macro and policy outlook.
Well, joining us now to break down the action is our EMEA equities editor, Ksenia Galuchko. Ksenia, yesterday was really a crazy day. What are markets now pricing in?
Well, yesterday was totally crazy with the S&P 500 finally closing in a bear market. And then today we were expecting a rebound, but it has been very fragile. So European markets opened higher. We were expecting finally the recovery to start, but it did not last, which just shows you that the caution is out there. Everyone is looking forward to the Fed, and that is the big surprise of this week. Are they going to go with a 75 basis point hike, or there's strategists floating the idea of 100 basis points? That will be a real shocker.
So the problem is that also it hurts their credibility on why they haven't acted earlier and seen this right. But Ksenia, no recession at the moment is priced in, so we could fall even further.
That's right. Yeah, earnings have held up pretty well. I was looking at the Citi Earnings Revisions Index just this morning, and it's showing rising earnings expectations in Europe and a slight drop in the U.S. and global profit expectations. So analysts have yet to catch up with this doom and gloom in the markets. We have the Bank of America monthly fund managers survey out today, and it's showing that actually among fund managers and investors, the global profit expectations are at a 2008 low, and that is pretty significant. So there's this discrepancy between analysts and investors out there.
Ksenia, overall, I mean, I guess commodities kind of held up okay, which points to possibly no recession. But then we have this huge fragmentation debate, and Italian yields really moving.
Absolutely. And commodities are actually a very interesting story, because yesterday they were truly a haven out there. And commodities are moving on very different factors. It's not the Fed that's moving them. It's obviously the war in Ukraine. It's the supply crunch issues, right, around Russia. So it's a very different story. Actually, what's interesting in the Bank of America Fund Manager Survey on commodities today is that it's one of the longest positions among investor portfolios. So investors are very bullish commodities at the moment, and mining and energy stocks. So they remain positioned in that department.
Ksenia, thanks so much. Our EMEA equities editor there, Ksenia Galuchko, with the very latest on the markets. Now, in the midst of the market action, traders also boosted bets of a more aggressive path for Fed rate hikes. A 75 basis point increase this week is now being priced in by markets with a terminal rate of 4% by May 2023. Now, economists at major Wall Street firms were quick to change their calls. Goldman Sachs and Nomura both shifted on Monday to forecast 75 basis point hikes this week and at the Fed's meeting in late July. Well, JP Morgan also went to 75 basis points at this week's meeting, joining Barclays and Jefferies, who modified their calls Friday to the biggest increase. But even 75 basis points isn't large enough for some, with mounting talk of an even bigger rate increase.
They've already said, 50 in June, 50 in July. Given how bad the announcement was Friday, I think what Chairman Powell can do is bring that 50 forward. Even though there might be an initial sell-off on 100 basis points, I think there'd be a subsequent rally, because the Fed is finally getting hold of the narrative, which it certainly has lost over the last year.
Well, we're joined by Paul Donovan, UBS Global Chief Economist. Paul, great to speak to you right now. I mean, last time you were around, you were kind of saying there's inflation, but we're seeing also signs it's subdued.
Yep.
Have you now changed your mind?
No, I mean, if you look at the detail of what we got on Friday, and remember, of course, CPI is not the Fed's target measure for inflation. About a quarter of the index is in disinflation or outright deflation. You've got falling prices in the detail. Now, what's happening, of course, is that the bits of inflation the Fed can control, you're seeing disinflation and deflation. The bits of the inflation the Fed can't control, you've got strong inflation. So you've got this balance, and the question is, how much deflation is the Fed going to cause in the areas it can control to offset the bits it can't control?
But so it needs to hike rates quite aggressively, right? So is 75 basis points now a done deal?
No, so I think the biggest inflation threat we face at the moment is pundits inflating their Fed forecasts and competing frantically to get up with the highest possible number. The Fed is looking at a measure it doesn't particularly rely on.
Right.
It is saying, well, it was a bit higher than expected, but actually we've got a mixed picture. And I think it's going to be fairly sensible in its approach. So 75, I don't think is a done deal. It's possible, but I don't think it's a done deal.
But is there now runaway inflation? And what's changed in the last 6 weeks?
So nothing has changed in the last 6 weeks. I mean, this is the key thing, that when we look at the inflation picture, we are seeing where demand is weakening, prices are slowing or outright falling. So you're actually seeing that happen. We're not seeing out-of-control wage price pressures. So the wage cost price spiral just doesn't exist. This is why you've got negative real incomes, which is unfortunate. We're running out of cushions for certain groups. So lower income Americans have spent their savings. They're now forced to borrow on credit card for day-to-day living expenses. that's not a sign of something which is going to sustain. And again, it's a disinflation force in the economy.
Okay, is this like a nightmare scenario that we're dealing with because the Fed didn't see it coming?
Well, I think the problem for the Fed, of course, is that most of what they saw coming, the transitory inflation, that happened. The transitory bits of inflation have proved to be transitory. What they've then had is this commodity shock, which is a combination of Ukraine and climate, because it's a La Nina year, and we know that always pushes up food prices. So that's created a real problem for them, which was, frankly, impossible to forecast.
Was it, though?
Well, I mean, the La Nina effect is always difficult to how big an effect do you have in terms of pricing. Once you've had the war in Ukraine, the problem there was not so much the oil price, of course, but the refinery capacity and the refined oil price, and that's been quite difficult to get a handle on. We've also got a lot of complications in terms of shifting demand patterns. So consumers aren't behaving the way they normally do. We've seen more dramatic cuts in driving, but people being a lot more resilient about, no, we absolutely are going on holiday regardless of airfares.
I know. All I know, Bo, is that like 5 people actually asked me whether their mortgage rate will go up, and these are people in good jobs because they're worried because they're over leveraged. Yeah. And inflation is also going. Their energy costs of living are going up.
Yeah. So, I mean, there are constraints coming through. And so certainly, absolutely, in countries like the UK, where rates are sort of semi-variable, that is a concern for people. If you've got a variable rate mortgage, your cost of mortgage is going up. In the US, of course, the overwhelming majority are on fixed rate mortgages. And this is, of course, one of the quirks that, according to CPI, the cost of owning a home has been rising, when, of course, it's collapsed in the last 2 years. And so that does give a sort of a bulwark against a recession risk, because you've got more spending firepower for middle-income, home-owning consumers than the headline inflation number suggests.
So we have traders coming on saying this reminds me of 2008. It's not something that you see?
Economically, this is nothing like 2008. I mean,
Any parallels?
Not really. I mean, the problem in 2008 was you've got balance sheets which were extraordinarily stretched, and households had been, leveraging themselves up. And of course, we've got quite the reverse this time. We've got stockpiles of savings. Now, as I said, lower income households are now starting to borrow on credit card. That's not a problem now. Yeah. The trend could be problematic, and that might start to echo 2008 parallels. But again, for the higher income households, the top 50% of households in the States, they've got a stockpile of cash, they've got more savings than they've ever had before, and they are, to a certain extent, sort of insured against some of the problems we saw 15, 16 years ago.
So where do you see the Fed interest rate actually going in the U.S.? Does it, go much higher, maybe 5%, and then come down as they start cutting in 2024? So,
no, I think 5% is too far, because we've got a situation where either we're going to have very high inflation, in which case 5% isn't going to do it, or more likely, we're going to get an abrupt drop in inflation coming through. Because, I mean, if you look at what's happening with wages and so forth, the inflation is not being driven by labor costs, it's being driven by profit margins. You cannot continue this indefinitely. That at some point, the consumer is going to say, actually, we're just not spending. And look at what Target was saying with their results in the second quarter. They're basically saying consumers are cutting back, we've got excess inventory, and we're now going to have to go on a price discounting splurge to try and get rid of this excess inventory. That, on an economy-wide scale, is, I think, the more likely scenario, and that stops the 5% number.
All right, Paul, thank you so much. We'll talk also about the UK next. Paul Donovan, UBS Global Chief Economist, stays with us. Now, coming up, 50-50, Morgan Stanley's James Gorman says there's an even chance of a recession in the U.S. More on markets and the economy next. This is Bloomberg.
About what they call black soot caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now, we are dying slowly but surely, and our lifespan is reducing every day.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Unlikely at this stage to go into a deep or long recession. It's possible we go into a recession, obviously. Probably 50-50 odds now. But that's okay.
Well, that was the Morgan Stanley Chief Executive Officer, James Gorman, saying he sees a 50% risk of a U.S. recession. Still with us is Paul Donovan, UBS Global Chief Economist. Paul, what are the chances of a U.S. recession right now?
Well, I mean, if we're talking about a prolonged period of negative economic growth, I mean, it's inevitable at some point. You always get a period of below-trend economic growth at some point. This year, I think we've got quite a lot of cushions. I mean, remember, the middle-income consumer with their stockpile of savings, corporate balance sheets are okay. There's job security, so you're not getting real wage growth, but you've got job security. And that's quite important because it's when people are nervous about their jobs that they really change their spending behavior. Ultimately, the US economy is all about the consumer, and they are there to provide support.
So what do you do with the inverted yield curve?
Well, the inverted yield curve is never a great predictor of recessions, particularly in the current environment. It just doesn't really work because you're manipulating bond markets. I mean, the UK gilt curve has been inverted for most of my career. The UK has not been in recession for the last 3 decades. It's not a great indicator overall.
I have a million questions. One from Valerie, our queen of charts, basically saying, why would the Fed upset markets and not hike 75 basis points, given it's priced in?
Because the market, I think, has only suddenly come to this conclusion. And the Fed is here to run Main Street, not Wall Street. That's ultimately its goal. I think it could, as I said, raise 75, but I think that they're going to want to give a fairly measured signal about their tightening. The market has sort of fed on itself in the last 48 hours. 48 hours ago, the market wasn't here. The market was perfectly happy with 50 basis points. We get one number the Fed doesn't monitor going up, and all of a sudden the market is feeding on its own panic. And as I said, I need to be the highest forecast in the street. This competitive race to forecast the Fed up. That's not necessarily going to influence economists at the Fed,
You've just destroyed all of your competitors, accusing them of clickbait, right?
Well, we're all guilty of clickbait, but please follow me, @Donovan_econ on Twitter. But I think that there is a sense of panic here where the Fed is taking a step back and looking at things a little bit more rationally because it is dealing with Main Street. It's going to be looking at what we've had from the Beige Book. And of course, a lot of members of the Fed are going to have gone into this meeting with their minds pretty much made up on the basis of the evidence of the last month, not the evidence of the last 48 hours.
Okay, I have 2 quick questions. First of all, Italian yields. Will the ECB have to come up with a plan to convince the markets that they won't allow fragmentation?
I think they do need to come up with a plan to avoid Give them some time. As always, the ECB is late. I mean, they're never on time with anything. Everything in Europe is always done at 5 minutes to midnight, or actually generally 5 minutes after midnight. I mean, it's always very, very last minute. But yes, obviously they need to reiterate the integrity of the euro, etc. But I mean, do remember, the Italian government has an awful lot of experience at selling debt. So I wouldn't necessarily panic about Italian yields at this stage.
Yeah, I keep on hearing that from Rome. You know, it's the Draghi effect. Very quickly on Brexit, and of course these UK real wages posting their biggest drop in 2 decades. Will cable ever trade above pre-Brexit level of 1.45 again?
Absolutely, it will at some point, obviously. At the moment, the UK is in a different cyclical position to other countries. We've got the biggest tax grab in almost 70 years from the Johnson government. That's having a depressing effect on the economy. The real wage effect, bear in mind the bonus payments. Bonuses are being used to sort of top things up a little bit. It's not quite as bad as wages alone would suggest.
But 145 at some point.
Well, not this year, probably not next year. But the UK economy, does have underlying resilience. There is competitiveness. It's a longer-term view.
All right, Paul. As always, thank you so much, Paul Donovan, there, UBS Global Chief Economist. Now let's get straight to the Bloomberg First Word News. Here's Angel Feliciano. Hi, Angel.
Hi, Francine. The UK has unveiled legislation to override parts of its Brexit deal with the European Union. The move risks a trade war with the EU, which has threatened to take legal action. If passed, the bill would give the UK the power to unilaterally rewrite the bulk of the Northern Ireland Protocol, which kept the region in the EU single market after Brexit. Hong Kong's lobby group for fund managers is urging incoming Chief Executive John Lee to scrap quarantine rules for travelers. The Hong Kong Investment Funds Association says the city needs to restore its status as an international financial center. The body represents firms with more than $52 trillion in assets under management. And emergency crews from California to New Mexico have been battling wildfires that have forced hundreds of people to leave their homes. The fires, such as this one in Arizona, have been driven by high winds that have grounded aircraft that would have been used to fight the blazes. The number of square miles burned so far this year is more than double the 10-year U.S. national average. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Francine?
Angel, thank you so much. Angel Feliciano in London. Now, coming up, but despite the tightest labor market in living memory, high inflation in the UK is reducing the spending power of households. We discuss what this could mean for the Bank of England next. This is Bloomberg.
at the Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question.
Great question.
Great question.
Great question.
Great question.
That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts. Great questions. However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia.
This is Bloomberg Technology.
This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, the UK cost of living squeeze is intensifying, with the spending power of households falling by the most in at least 21 years. Now, this backdrop, of course, created a major challenge for the BOE as they tried to curb inflation without pushing the economy into a recession. Now, for more on this, we're joined by Bloomberg's EMEA economics and government correspondent, Lizzie Burden. Lizzie, so what does this exactly mean for the Bank of England? This is like a tough environment for households, but it's also a tough environment for companies that have to pay wages more.
Exactly. So you've got something for the hawks and the doves in this data, because on the one hand, it underscores the pain of the cost of living crisis, because inflation is swallowing up real wage growth. But on the other hand, it shows how tight the labour market is, but that it's easing. So unemployment rate unexpectedly rose, but that was driven by the rise in the drop in economic inactivity. So our economists think that this doesn't change the calculus for the Bank of England on Thursday. They still see 25 basis points, and that would take the key rate to 1.25%.
I mean, what are we expecting UK consumers to do? Because if your real wage, I mean, you have to spend less at some, in certain items.
Yeah, well, you've got low consumer confidence in the UK, but interestingly, in the GDP figures yesterday, you didn't see that translating into a hit to demand, because you still saw people going out shopping, and so that hasn't happened yet, but it's not to say that it won't happen down the line.
All right, Lizzie, thanks so much. Lizzie Burden there with the very latest on the UK data. Now, stocks in Europe are pretty much steady. If you look at US futures, also steady, certainly more stable than they were yesterday, where we had this crazy volatile day. They rebounded after a market rout driven by expectations of sharper Federal Reserve interest rate hikes to fight inflation. I'm looking, for example, at the Stocks Europe 600. Now, they're now unchanged, so they did pair an earlier gain to hover at around a one-year low. Banks outperformed HSBC, for example, climbing some 3% amid speculation that it may spin off its Asian unit. And then the one thing we need to watch out for is also Italian yields. The 10-year above 4%. When does the ECB, if the ECB steps in to show the markets what tools it has to deal with fragmentation? Coming up later this morning, we'll speak exclusively to the Hong Kong Chief Executive, Carrie Lam. That's an interview you don't want to miss. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Stocks rebound in Europe along with U.S. equity futures as the sell-off takes a breather. Markets await the next data point. PPI drops at 1:30 UK time. The 100 basis point question, will markets start pricing in even more dramatic hikes by the Fed? JP Morgan sees a 75 basis points, but describes a full point hike as a non-trivial risk. And dip buyers rush back into crypto. Bitcoin pairs a plunge of 10%, but still trades lower than at any point since December 2020. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, all but 5 stocks in the S&P 500 tumbled yesterday. The benchmark posted a more than 20% loss since its January peak, crossing it into a bear market. Asian stocks extended the sell-off this morning as investors continued to process the possibility of a more rapid Fed tightening. Now, it's been enough for some to resurface scary memories of the global financial crisis more than a decade ago. Here are some of the reactions from our guests to the broad market sell-off.
This week is fraught with peril.
Inflation is really the Achilles heel of risk markets.
Markets are reacting the way they are because they believe the Fed is going to be forced to get more aggressive than they had expected.
I certainly don't think that a 75 basis point hike is out of the question.
Even though there might be an initial sell-off on 100 basis points, I think there'd be a subsequent rally because the Fed is finally getting hold of the narrative, which it certainly has lost over the last year.
This is a time to be selective, but I wouldn't sit on my hands.
There are opportunities in areas where one can position.
Pockets of stocks that have been proven.
Europe looks good to us. China looks good to us. The credit space in the U.S. looks good to us.
Equities in general, specifically in the U.S., I'm still pretty cautious here.
It doesn't have to be all about the U.S.
Because I still think we've got some wood to chop with respect to the macro and policy outlook.
Now, more on the markets with Christian Muller-Gleesman. He's Goldman Sachs International Managing Director for Portfolio Strategy and Asset Allocation, and he joins us now. Christian, always great to speak to you. Thanks so much for coming on. I don't know how many traders were hiding under their desk yesterday, but I'm sure a large part, of course, suffered some huge losses because of this huge repricing. What happens to markets from now?
Yeah, listen, I think you heard it in the comments earlier. There was a hope that we are getting closer to peak inflation, but I think inflation risk is still dominating. And inflation risk matters from 2 perspectives for markets right now. On the one hand, we are kind of reversing a valuation equilibrium we built over the last 20 years, where this low inflation has allowed equities to trade at higher multiples, especially longer duration equities. So that's coming a bit out of the market. But at the same time, the monetary policy tightening process, which is accelerating now, and our economists are expecting a 75 basis point hike at the meeting, and I think the market has shifted to that very quickly. I think that also triggers recession risk. So markets have to deal with both of those issues. And that also means that multi-asset portfolios like 60-40, these type of balanced portfolios, they're kind of feeling it on both sides, no? And you have like big drawdowns.
Yes, Christian, actually, we were speaking to BlackRock's Scott Thiel a bit earlier on, and he said there has not been a worse time to engage in that 60-40 portfolio. Let's have a listen to what he said.
It's also the worst year for a 60-40 or 50-50 portfolio of all, in the last 30 years. And so that obviously is going to move people into a more defensive position.
So do you agree with that, Christian?
Well, you know it. I mean, we've written a research note called The Balanced Bear end of last year, where we kind of made exactly that point, that these portfolios are carrying much more risk when there is inflation. Bonds cannot buffer equities, and there are these negative feedback loops from bonds to equities, where I always say, like, in the last 20 years, it was primarily growth volatility that drove rates volatility, whereas this reaction chain is now reversed. Now rates volatility is driving growth volatility. So to fix that problem, what we've been advocating is that you focus on more short duration assets, both within asset classes, but also across assets. And you focus more on real asset allocations like infrastructure, commodities, real estate, gold, and anything that kind of can protect you from this high inflation.
Christian, how would you describe yesterday? I know there was this market rout. You know, we've been speaking to traders all day, and they were saying, you know, some parts of the market, certainly the bond rout, what we saw, for example, in crypto going haywire, in terms of market function, held up, but a lot of the moves reminded them of what happened in 2008.
Listen, I mean, if you have such a large decline in equities, you definitely are reminded of the worst of times in equities, no? But I would say that the type of VIX spike, the type of kind of capitulation metrics we are tracking is not really at the kind of crisis levels where you could say that we have complete capitulation. And I think our risk appetite indicator as well, which kind of tracks how bullish or bearish investors are across assets, I think that was roughly neutral going into this and has shifted negative, but it's far from these kind of bombed out levels where we would really say that market functioning and capitulation is incredibly extreme. So I think I wouldn't necessarily say that what we've seen yesterday now creates a huge asymmetry where we can say that markets cannot fall from here, because that's clearly always what people are hoping for, that you now have seen that capitulation and you can move on. I think until the fundamental picture improves, you're likely to still stay in a bit of a volatile period.
Yeah. How much do you worry about liquidity?
Listen, I mean, we look at a few metrics, like the top of book depth in the futures markets has been pretty low year to date. And I think generally, like, if you look at kind of liquidity metrics in fixed income space, I think all of them have been a bit lower. But that also reflects the uncertainty and the volatility. So I think like liquidity to some extent exacerbates fundamental moves, but it doesn't create always necessarily like new fundamentals, if that makes sense. So my sense is, yes, the liquidity might exacerbate moves right now, but I think it's not that unusual to see lower liquidity if you have so much uncertainty currently. I mean, you have to consider rates volatility in the swaptions market is priced to all-time highs in the front end nearly. I think you're dealing with a lot of uncertainty, so I'm not surprised that market makers are kind of a bit more cautious.
Christian, how do you see the interest rate hikes actually evolving? First of all, why would the Fed take the chance of disappointing or not going for 75 basis points this week, given it's already priced in?
Yeah, it was a weird kind of communication timeline, but I think our economists now think that with the kind of newspaper articles you had yesterday, that the highest probability is that you do get that 75 basis point hike at the next meeting and another 75 basis point hike after that. And I agree with you. I think the Fed has gone a bit with that shock and awe kind of technique. You had that CPI print, you had the University of Michigan inflation expectations as the likely trigger. So I think, obviously the market reaction has been aggressive. And the question now is if that changes the Fed's outlook for kind of the effectiveness of what they're trying or what they have to do. But at the margin, you could argue that it's not been that extreme in terms of like the broader picture, the tightening of financial conditions.
All right, Christian, thanks so much. Christian Muller-Gleesman, Goldman Sachs International Managing Director for Portfolio Strategy and Asset Allocation, stays with us. We'll talk about European bonds. We'll also talk about currencies around the world. Coming up, the Bank of Japan has accelerated its planned bond purchase operations and included longer maturities where yields are steepening amid a global debt round. We have more on that story next, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, the Bank of Japan accelerated its planned bond purchase operations and included longer maturities where yields are steepening amid a global debt rout. The central bank bought 2.2 trillion yen worth of government notes through its fixed rate operation. Now, for more on all of this, we're joined by Bloomberg's senior Asia economy reporter, Michelle Jamrisco. Michelle, thank you for joining us. So, first of all, what makes the BOJ's decision so complicated?
Well, Francine, this is Japan is one of the countries that we've been looking at as one of the big ones alongside China that's just going against the grain right now. Is increasingly complicated in terms of their central bank decision. Of course, as you mentioned, they announced this afternoon the scheduled operation they boosted on 5 to 10 year debt purchases, as well as that unscheduled operation on longer term maturities. What we're seeing now is investors, perhaps seeing this as a modicum of stability in an already wild week, but something that's increasingly seen as untenable, especially in the longer end. I mean, what we're seeing here in a world where, the Fed is poised to perhaps surprise the hawkish side, it's only going to put Japan further out in the cold. But it's increasingly complicated. I mean, we look at the history here, of course, of decades-long deflation, secular deflation. Of course, the BOJ is going to want to see a little bit of inflation here and there, but increasingly untenable path with the way the consumers and businesses are responding right now. They can't all be the perspective that your neighbors have right now in terms of having seen the worst inflation behind us.
Yeah, it's pretty incredible. I know it keeps you busy. The BOJ holding, of course, it's a widening policy gap that's eroding yen. Michelle, thank you. Michelle Jamrisco there joining us from Japan. Now, still with us is Christian Muller-Gleesman, Goldman Sachs International Managing Director for Portfolio Strategy and Asset Allocation. Christian, the currencies at the moment are extremely volatile. So is it like catching a falling knife?
Well, we know the only currency that has really decoupled as a bit of a safe haven and has essentially a central bank behind it that is fighting inflation in a somewhat credible way has been the dollar. And I think we have to acknowledge the type of increase in real yields yesterday in the US has been remarkable. The TIPS yield has kind of moved now to 60, 70 basis points. I think on a global basis, there's no other kind of longer dated bond that offers you that type of real yield, at least in developed markets. So it feels to me that the dollar has been the key safe haven, and it's very tough for any other FX to stabilize against that right now.
Christian, where do you see the market, how do you see the market pricing in the risk of a recession? So is it something that they're completely discounting when it comes to U.S. markets right now?
Yeah, it's always difficult to disentangle the pricing, especially right now, because if you look at equity drawdowns, they're both reflecting, as I mentioned earlier, a bit of a valuation derating because of this higher inflation volatility, this higher inflation level. But then at the same time, they're discounting a bit of recession risk. So it's not so easy to necessarily extract the pricing. We're looking at the yield curve, of course, which has inverted again. So that sends you a signal that recession risk pricing has picked up. We're looking at cyclicals versus defenses within equities. They have been pricing a bit of an elevated probability of a recession or a sharp growth slowdown. And of course, what we are starting to see is that credit and the VIX as metrics have started to kind of discount higher recession risk again. So I think we're moving closer again to the recession scare, which we've had a few weeks ago in terms of the pricing. I don't think we're past that yet in the sense that markets are pricing more recession risk than a few weeks ago, but we're getting there. I think markets are definitely getting more nervous maybe than when we were last having a recession scare.
So, Christian, what's the terminal rate for actually interest rate hikes in the U.S.?
Listen, I think our economists have been at 3.5, and I think with that they are now below or where market pricing is shifting to, which is closer to 4. And they've been writing that yesterday as well. They feel like now we're getting to a point where market pricing is actually moving beyond what is needed to slow down the economy. So to your point, I think you should probably be worried a bit more about recession risk compared to a month or so ago. I think at least our economists would be based on that statement.
What do you do with some of the periphery bonds? So we saw, a pretty big move. I guess you call it a big test when it comes to Italian BTPs trying to, I guess the market wants to know the ECB's resolve in dealing with fragmentation.
That's right. I think like the big difference you kind of have right now is that the ECB has already said that they're planning to introduce a sovereign backstop to deal with fragmentation risks, but we don't have the details. And without the details, the market needs to price some type of probability of something with that backstop going wrong, the backstop having some conditionality, having something attached to it that might not be as market friendly. So I think that means that the volatility of BTP spreads is likely to remain a bit higher until we have those details. Having said that, one has to say, compared to previous stress episodes in euro area sovereigns, it's pretty limited, the stress. And you also have to look at the spillovers. If you look at banks, I think, of course, in aggregate, they've done very poorly, and there's a bigger concern on banks, loan loss provisions, etc., with regards to recession risk as well, not just sovereign risk. But what's really interesting is Italian banks, for example, have not necessarily underperformed euro area banks a lot. So it doesn't seem to be only related to Italy and sovereign risk that you've seen that sell-off in banks.
So, Christian, is there anything that you would buy either in the equity space or elsewhere in Europe right now?
Yeah, I mean, to me, as I said earlier, in the asset allocation, we're currently overweight commodities, overweight cash, and in the kind of risky asset space, we would really focus on real assets and shorter duration assets. I think in Europe, that means to me a big opportunity in infrastructure. I think there's a lot of interesting infrastructure equity that have proven to be quite defensive year to date in what we're dealing with. Because if you think about it, a real asset doesn't necessarily have to derate on the valuation if you have higher inflation risk, because the cash flows are real. So the valuations are less at risk if you own an infrastructure stock. And we've seen that year to date, they're really decoupled and generally focus on these areas, high dividend yield stocks, a bit more quality, which is short duration, a bit less exposed to recession risk. That's kind of where we would look at in Europe right now.
Well, Christian, as always, thank you so much for joining us. Christian Müller-Gleesman, Goldman Sachs International Managing Director for Portfolio Strategy and Asset Allocation. Now let's get straight to your Bloomberg Business Flash. Here's Angel Feliciano. Hi, Angel.
Hi, Francine. Two giant Wall Street banks are said to be withdrawing from handling trades of Russian debt. That's in response to the Biden administration's surprise announcement last week that it's banning U.S. investors from scooping up such assets. Bloomberg has learned that J.P. Morgan Chase and Goldman Sachs were still matching sellers who wanted out of the debts with interested buyers this month. The U.S. Treasury's Office of Foreign Assets Control has said investors in the U.S. aren't allowed to acquire them. Sources tell us a joint venture between Paramount Global and Reliance Industries has snatched online streaming rights to the Indian Premier League cricket. The result is a blow to Disney's streaming ambitions, with the sports seen as a big contributor to global growth. After a bidding war, Disney did secure broadcast rights for TV. Each deal is said to be worth up to $3 billion, according to media reports. And the biggest operator of London's commuter trains and iconic double-decker buses has accepted a £648 million takeover bid from an investor group backed by Australian rival Kinetic. Shareholders of Go Ahead will receive a total of 1,500 pence per share in cash. That represents a 24% premium to Go Ahead's closing price on Friday. A pause in withdrawals from crypto lender Celsius is sending fresh shockwaves across the digital asset market. The key player in decentralized finance halted withdrawals, swaps, and transfers after weeks of speculation over its ability to deliver yields as high as 17%. Cryptos are still reeling after the recent implosion of the Terra stablecoin. And that's your Bloomberg Business Flash. Francine?
Angel, thank you so much. Angel Feliciano there in London with me. Now, coming up, Digital Dive, we take a closer look at the crypto sell-off triggered by that surprise inflation reading, which hit a 40-year high. We also look at Italian yields. The biggest concern out there is, of course, this lack of clarity on how the European Central Bank will deal with rising borrowing costs. Amongst the region's riskiest debt, of course, has sent, for example, Italy's benchmark yield rising a shade above 4% for the first time since January 2014. Now it's just below that price point. This is Bloomberg.
companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
A lot's happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, the value of the global crypto market has slipped below $1 trillion. Bitcoin dropped to an 18-month low, and the NFT index saw a 23% decline. Popular NFT collections have been hit hard as inflation proves to be even trickier opponent to beat than expected. Now, let's get straight to our crypto reporter, Emily Nicole in Zurich. Emily, you're an expert in this. So what's going on in crypto right now?
So as you mentioned, we've definitely seen a large market rout over the last day or two. Crypto prices have been plummeting. Bitcoin fell as low as 20,000 earlier today, but it's also stabilized somewhat. It pared back those gains this morning too. And it's not just Bitcoin as usual, it's all of the assets all going at once. So Ethereum is also falling. Some of the altcoins were struggling too, and you mentioned NFTs. So we're definitely feeling the pain for investors across the board right now.
So how is this different to the crashes we've seen in the last couple of months?
So what we saw last month was a crypto crash that was sustained by the collapse of a project called Terra. That was a stablecoin project that was upheld as one of the biggest experiments in decentralized finance, and that came tumbling down. And this month, the thing that we think is triggering it is not just the overall concerns that every investor is feeling in parts of traditional finance about interest rates and things going on with the Federal Reserve, but also some impact from stuff happening in crypto too. Over the weekend, there is a project called Celsius that uses a staked version of Ethereum to prop up its activities, and that suspended withdrawals for investors, which sent some panic spirals going through traders because, if you think about what would be the early warning signs for the previous collapse, that's kind of what they think they're seeing here, and that definitely caused some contagion across crypto assets.
So is there an end in sight for this? How should we look at what could happen next?
So if we look ahead to what we think might be coming for crypto prices in the next few days, there's some element of stability returning this morning, but it's definitely extremely volatile, and we're not too sure, where the market pain will end. However, what we are looking for, at least from that crypto project I mentioned, Celsius, is a little bit of confidence from them as to whether or not they might be able to restart activity, and also looking ahead to this broader thing that's happening within crypto called the merge. It's an upgrade for the Ethereum network. That's sort of what's compounding the problems for Celsius at the moment. And if we see any signals that that upgrade is going well, that might also help boost investor confidence in the market.
Emily, thanks so much. Emily Nicole there from Bloomberg Crypto. Now, let's also go back to the markets. We did start the day on a higher note when it comes to European stocks. A lot of that enthusiasm or that stability starting to fade away. If you look at U.S. equity futures, they did rebound. Treasury still snapping a 4-day sell-off after this market rout driven by expectations of sharper Federal Reserve interest rate hikes. to fight inflation, but the opening bounce in the Europe Stock 600 then quickly faded. In fact, I'm looking at the gauge, it's hovering around a one-year low, suggesting that concerns about aggressive monetary tightening have not completely eased off. And bond yields also in most of Europe were steady. Gilts gained after data showed in the UK that spending power of households plunged as inflation eroded wage increases. Bloomberg Surveillance Early Edition continues in the next hour with Matt, Kaylee, and Anna. This is Bloomberg.
Almost the end of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping, but many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada 1-2 itu ada, tapi nggak kayak dulu. Kalau dulu rame sekali, sekarang paling dapat jualan ya 100-120 gitu, 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 itu nyampe dapat jualan, bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu, sama aja. Belum ada turis ke Bali, masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This week is fraught with peril.
Despite all of these leading indicators, we have not seen the central banks blink.
The Fed doesn't have much reason at this point to slow the pace of rate hikes.
If they're going to do 75, it's better to do it sooner than later.
We can start to sort of look for areas of the market now that have been de-risked.
The markets are performing incredibly well. There's a ton of liquidity in the market. There's a lot of transparency in the market.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kaylee Lines.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong on this Tuesday, June 14th. Our top stories today. European stocks and US futures breathing a little easier following yesterday's mayhem. Investors seeing a pocket of calm after the S&P 500 plunged into bear market territory. Did markets say 100? Markets start pricing in even more dramatic hikes by the Fed. JP Morgan sees 75 basis points, but describes a full point hike as a non-trivial risk. And the crypto chaos shows no sign of letting up. The market sank below $1 trillion. Bitcoin continues its descent, while the fortunes of crypto billionaires are vanishing as quickly as they were made. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kaylee Lyons in New York. And Kaylee, the conversation continues over just how big the hike from the Fed is going to be then tomorrow. That feels like the big question hanging over the markets. And in that context, you have to wonder how soon will the turbulence return?
Yeah, have we seen a bottom yet, Anna? Is that what we saw yesterday, full capitulation, or does this sell-off have further to go? These are all questions that we're still looking for answers to. Of course, it wasn't just U.S. stocks that fell into a bear market yesterday. It was global equities, and you saw a little bit of that continuing in Asia overnight. Though Asian equities were able to close off of session lows, you still had the MSCI Asia Pacific Index down by nearly a full percentage point. And of course, it hasn't just been equities selling off as we reassess not just Fed expectations, but global central bank expectations. We have seen massive selling pressure in bond markets around the world, and that definitely continued in a massive way in Australia overnight, where the 5-year yield was up 31.5 basis points. 3.665% is where we trade at the moment. That is the highest going back a decade to March of 2012. You also are seeing the Japanese JGB yield falling below 25 basis points because the Bank of Japan is maintaining yield curve control, buying more bonds, keeping policy easy, trying to maintain that upper bound, no matter what the cost is, apparently, of the Japanese yen, because the Japanese yen, right around those 1998 week levels against the dollar, Matt, we're trading right around 134.21.
Yeah, continues to be a fascinating story out of Japan. Here in the U.S., we officially entered a bear market yesterday. We're down 21.3% year to date. Right now, you see futures bouncing a bit after that big move down. Really, three big 2% plus, 3% plus down days in a row. So maybe we get a little bit of a recovery today. We also look like we're going to see a little bit of a recovery. We are seeing a little bit of a recovery in yields. We were up to 337 at the highest level, and that is a record, the most since 2011. Right now, we're back down to 330, still at 2011 highs. NYMEX crude up just about 88 cents right now, 121.80 barrel. Remember yesterday we started the session off with crude down on COVID lockdown concerns out of China, and then it turned around and rose today at the end of the day, really exacerbating the market pain. Bitcoin, speaking of market pain, it dropped yesterday to 21,000. Right now it's at 22,617, but getting very close, as Eddie Vanderwalt points out, and we're going to talk to him a little bit later, to the highs that it reached during the last halving. And if it falls below those highs, it's going to be something new for Bitcoin. Okay, it's only 10 years old, but very interesting stuff, and we'll talk to Eddie about that later. Anna?
Yeah, more from Eddie on that subject later on. Let's get to the European equity markets, and this is the picture we have for you right now then. European equity markets fairly flat, a little bit of respite, a little bit of digesting, really, what's happened over the last 24 hours or so. Such has been the pace of the rethinking of expectations of hikes from the Fed and, to some extent, other central banks around the world. So we got a pretty mixed picture. Mixed, flat, slightly negative, actually, increasingly so, perhaps. The CAC Caron down 0.5% now. The DAX down 0.1%. We just got the ZEW investor sentiment data out from Germany. It was in negative territory. Didn't seem as if it was so much of a game-changing number, but we'll keep an eye on that, of course, given sentiment as fragile as it is, perhaps. We do see some gains in some sectors today, though, and energy stocks, to Matt's point about a higher energy and oil, or higher oil price, that's a sector that's benefiting. We also see banks rebounding a little bit from the lows of yesterday. So just as we saw Italian banks beaten up by concerns around fragmentation, some of those Italian names that were gaining today and were up by 1.4%. That's also in focus as we look at what's going on with euro-dollar. Interesting that the euro seems to have detached itself from the global interest rate narrative over the past few days. Post the ECB, there was a lot of talk about ECB and what that would do to the periphery of Europe, but that seemed to weigh, that peripheral fear seemed to weigh on the euro rather than expectations of tighter policy support the euro. And today we see a little bit of a a rebound from those recent lows, and certainly a rebound from the strong dollar that we saw in yesterday's session. Italian two-year yields a little bit calmer than they were yesterday. We still see action in the two-year part of the curve, of course, and we still see a lot of focus on this. We're going to hear from Isabel Schnabel of the ECB a little bit later on. What will she have to say about fragmentation risk? And Atos, this is a French tech business. I put this in here. They're talking today about restructuring of the business, and they've announced that the CEO is going to depart. That comes as a surprise to investors, and the stock was down a lot more than this, now down by 16%, Kaylee.
Yeah, still a massive move. We'll continue to pay attention to that throughout the day, Anna. As for what else is ahead, on this Tuesday, Biden is traveling to Philadelphia, Pennsylvania to deliver remarks at the 29th AFL-CIO Quadrennial Convention. He's going to be talking about the power of the American worker. Then in terms of politics, U.S. primaries are held in Maine, Nevada, North Dakota, and South Carolina today. And then on the economic data front, we'll be getting U.S. PPI data at 8:30 a.m. New York time. And several economists, Matt, say this is the one to pay attention to. It may be even more important than last week's CPI.
All right, we'll be paying very close attention to that. Actually, Neil Dutta wrote a note about that, and we'll talk about it a little bit later. Right now, pockets of Wall Street are raising the possibility that the Fed could consider the biggest interest rate increase since 1994 when it meets this week, with some predicting a 100 basis point hike, including Wharton School finance professor Jeremy Siegel. He spoke on Bloomberg yesterday.
Even though there might be an initial sell-off on 100 basis points, I think there'd be a subsequent rally because the Fed is finally getting hold of the narrative, which it certainly has lost over the last year.
Siegel also spent some time running the shadow Fed. Now, economists at major Wall Street firms have been quick to change their calls. Kriti Gupta, Bloomberg Markets correspondent, joins us now to tell us about, everybody's seemingly trying to go higher and higher.
Everybody. I mean, remember, we've been here before where the market is getting ahead of the Federal Reserve to some extent. The fear here is that that's going to happen again. Take a look. In just the last 24 hours, you had J.P. Morgan, Goldman Sachs, Evercore all come out and say 75 basis points is their new base case scenario. Of course, this following a report from the Wall Street Journal saying that this actually could very actively be considered in the meeting. And of course, we know Nomura and Barclays and Jefferies had already made that call for 75 basis points as well. But what's important here is the read-through, because we know the market has already been pricing it aggressively since Friday, a CPI report that was extremely high, consumer sentiment at record lows once again. But the read-through here is recession risk. At the end of the day, can the economy really digest a 75 basis point hike? And that's really going to be the concern. Look into the markets beyond Fed swap spreads, and you're actually seeing that the Treasury curves, the 2s, 10s, the 5s, 30s, the ones that we like to look for recession risk, well, it's flashing that signal once again. It tells you there is worries actively in the market. Can the economy actually digest this?
Well, you mentioned that J.P. Morgan, Michael Feroli, is one of those calling for 75 basis points tomorrow, but he said the risk is non-trivial that they actually move 100 basis points, which would be in line with Professor Siegel. Interestingly, though, and a strategist over at J.P. Morgan, very closely followed, pretty much always bullish, Marko Kolanovic, was out saying that we think it's going to move 50 basis points, and he basically went on to say that the rates market has overdone this pricing, that the Fed is going to surprise devishly. And well, maybe that is true as well. He says that the Fed will surprise devishly relative to what is now priced into the curve. So, Kriti, if the market has overdone this, and given the moves yesterday, not just in the bond market, but in the equity market as well, where only 5 stocks in the S&P 500 were positive yesterday, have we seen capitulation? Was that the big washout, cathartic puke, as some call it, and now we're done?
Well, cathartic puke, that's quite the statement. This is interesting when you talk about the different ways this could play out, because the assumption here, the consensus is that if you do get a 75 basis point or 100, as it is starting to seep into the conversation, is that would basically be the straw that breaks the camel's back. That would be your signal of capitulation. But there is an argument in the market that you'll see the opposite, that there'll be a sigh of relief in the market, and off the back of, say, 75 basis points or 100 front-loaded, basically all the pain goes out in one go. And essentially, I think there's a phrase, a Mary Poppins phrase, a spoonful of sugar helps the medicine go down. Something similar to that.
That is, Anna knows it well. Anna?
That is correct, Kriti. Yes, I can confirm the correctness of that statement. Thanks very much, Bloomberg's Kriti Gupta, on whether we've seen capitulation in these markets. Have we seen any capitulation on Bitcoin? Let's talk about crypto. Bitcoin delivered another white-knuckle ride Tuesday, dropping 10% before pairing much of that slide, still down 2% and change. That's as speculators struggle to price in the prospect of even bigger Fed hikes. Eddie van der Roosevelt of our Bloomberg Markets Live team has been following the action and is with me. I mean, it's a wild ride, isn't it? Tin hat kind of stuff, I suppose. Some people might call it. 22,000 is the handle on Bitcoin now. Eddie, where have we got to on this, and how much further does it fall?
Yeah, absolutely. I think, you know, the real capitulation here started with that CPI reading, which just shows us that Bitcoin at the moment is very much a risk-on asset and is liquidity driven. And as the liquidity drains out of the market, the headwinds for crypto keep growing.
Hey, Eddie, thanks so much for joining us. We're going to be talking about this obviously all day long, and I'm going to be using your chart as well later on. Bloomberg Crypto. That's at 1 p.m. New York time, 6 p.m. London. For more on the crypto chaos, Kaylee and I do it every week. We'll speak today to an investor who's been sounding the alarm on Celsius, as well as one of the first Wall Street crypto analysts, Nick Carter, of course, now of Castle Island Ventures. Let's get back to the BOJ ramping up the defense of its policy framework after yields came under renewed pressure, upward pressure. Our chief Asia economics correspondent, Enda Curran, has the latest on the Bank of Japan. Enda?
A very aggressive intervention in the bond market today, Matt. It was unscheduled. They came in to buy 5- and 10-year dated bonds. And what this underscores is how committed Japan's central bank is to supporting its economy, to keeping bond yields low. Now, that's a very stark divergence from where the Fed is at, for example. And even though inflation in Japan is increasing, the authorities there are pinning much of that on the imported cost of oil rather than underground strong demand. We do have the Bank of Japan meeting this week. We might get more detail on where they will bring that policy. Some economists say they may tweak that yield curve control strategy that they have. But today, at least, they came into the bond market in a big way, signaling that, unlike its peers, the BOJ remains committed to supporting its economy.
Yes, and so a lot of people in the market's asking how long that divergence between the BOJ and others can continue. How long can they continue to withstand the pressure of rising rates? Now, let's switch to what's going on in Hong Kong. And Carrie Lam, the outgoing Hong Kong chief executive, speaking with Bloomberg just a few moments ago. Let's take a listen to what she said.
Despite some skepticism and cynicism about Hong Kong's future, I remain very optimistic and confident of Hong Kong's future. And one of the reasons for my confidence and optimism is Hong Kong's unique strengths under one country, two systems.
Carrie Lam there. She's optimistic about Hong Kong's future. She does acknowledge, though, that the weight that has been applied to Hong Kong by the way that COVID has been handled in China and Greater China. What do we know about the Hong Kong economy and how it's withstanding the latest from COVID?
Well, Carrie Lam will finish as chief executive in a few weeks. Her message on the way out the door has been that COVID-0 is now damaging Hong Kong's status globally as an international finance hub. And there are big expectations here, Anna, that the incoming government after July 1 will change things up and perhaps ease the quarantine at the airport. In particular, lobby groups are out every day of the week making this point that the economy does need to be reopened. Now, what I would say is, while Carrie Lam made those points about being optimistic for Hong Kong today, at the same time, her government were reintroducing new restrictions on entering bars that come into effect tomorrow night, requiring a rat test to be negative before you go into the bar. So there's still a long way to go before Hong Kong is fully reopened.
All right, Bloomberg's Enda Curran in Hong Kong. Thank you so much. And we'll have more from that interview with Carrie Lam throughout the day here on Bloomberg Television. Meanwhile, President Biden will travel to Saudi Arabia in July and meet the country's de facto ruler, Crown Prince Mohammed bin Salman. That's according to an NBC report. Anne-Marie Horder, Bloomberg Washington correspondent, joins us now with more from D.C. So, Anne-Marie, the White House said yesterday that a trip is in the works. Nothing is final yet. They also said this isn't just about oil. Is it really just about oil?
It's not. On one hand, it is in the sense that obviously the war in Ukraine, Russia's invasion of Ukraine, that has started to shift the tides in a number of capitals around the world about making sure they shore up their allies. And it changed a lot of diplomatic priorities. And that's obvious for this administration, which the president campaigned on making Saudi Arabia a pariah, now is going to be engaging not just with the kingdom, but if he's going to go to Saudi Arabia, he's obviously going to be engaging with the de facto leader, and that's the Crown Prince, Mohammed bin Salman. When it comes to the oil market, you did see a bit of an olive branch in that last OPEC Plus meeting, but I think people sometimes lose track of where we are right now in the oil market. Saudi Arabia and the UAE, yes, are the two countries that have spare capacity, but they don't have spare capacity to solve $5 a gallon gasoline. That's also only one part of the problem. when you look at the relationship, it'll likely be focused, obviously, on energy, but also strategically, regional issues, defense issues in the region, and as well as economic issues. So if the president does go there, he'll be meeting with not just Saudi officials, but also others, part of the Gulf cooperation, and there'll be a number of issues on the agenda.
All right, Bloomberg's Anne-Marie Horder in Washington for us. Thank you so much. Now let's get back to the markets and take a look at some of the stocks moving in pre-market trading here in the U.S. A big outperformer is Oracle. It reported earnings after the bell yesterday. Revenue topped estimates thanks to strength in the cloud and the database business. As a result, that stock is up nearly 13% before the bell. Another stock moving higher is Twitter. We got news overnight that Elon Musk is going to meet with Twitter employees at an all-company-wide meeting on Thursday, the first time he'll have addressed them directly since that $44 billion deal. Remember the price tag on that deal? $54.20 a share. Twitter's trading fractionally higher at $37.32 this morning. One other stock I wanted to check on is MicroStrategy. This, of course, is essentially a Bitcoin proxy because Michael Saylor, the company's CEO, is a huge Bitcoin evangelist. The company holds a lot of Bitcoin on its balance sheet. There is now concern about potential margin call because of how much Bitcoin has dropped. The stock was down 25% yesterday. Due to that, it's down another 1% before the bell this morning, Anna.
Yeah, the read across from crypto, then it continues. Coming up, Kaylee, we will talk to Art Hogan, Chief Market Strategist at National Securities. I spoke to people from the M Live blog earlier, and they were saying that the Fed will do as much hiking as the market will let it get away with. How much is that? We'll ask Art for his perspective. We'll also speak to Dominique Duofreco, somebody with experience of working at the Fed, now a macro strategist at Macro Hive. We'll get her take on how the Fed operates in this environment. Plus, breaking the bank or the law, how the post-Roe reality is playing out in Texas. Read more by typing NI Big Take into your terminal. This is Bloomberg.
City of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani. His company Reliance has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the Indian government's plan to reach net zero emissions by 2070. But Ambani is not alone. India's second richest man, Gautam Adani, has committed $20 billion of investment over the next decade. But India's massive dependencies on fossil fuels have some environmental advocates questioning the realism and sincerity of those green ambitions and those of its two biggest billionaires.
This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month and all year long.
This is Bloomberg Surveillance Early Edition. We are simulcast on both Bloomberg Radio and on Bloomberg Television. I'm Matt Miller with Kaylee Lyons in New York, Anna Edwards with us out of London. Now, Joining us is Bloomberg M Live's Tatiana Daria to talk about what we saw yesterday in terms of yields and the sell-off. And all of this is very interesting, especially when put into context, Tatiana, of inflation. You're writing about that on the M Live blog today. We have rarely seen such a big gap between the core and the headline numbers, which, when you think about it, makes a lot of sense, because if you're spending all of your money on food and gas, you don't have enough for the other stuff. No more demand for the iPads, bicycles, and T-shirts or whatever. And as a result, those prices drop.
Exactly that, and that hurts profits and therefore hurts stocks. And like you mentioned, if we look back historically, there have been just 5 occasions when we saw that gap really widen past the 2 percentage points. We're at 2.6 percentage point right now, the largest since 2008, and that has tended to occur around recessions, and that is never a good thing for stocks, obviously. But the other common thing about them is that those were the times that we saw energy prices skyrocket. 1973, 1980, those were the oil shocks. 2008, obviously, we had bigger issues going on with the housing crisis, but oil also jumped to $146 or so. So that's also been a case where high energy has fed through those inflation problems.
Well, and obviously, because of the inflation problem, this is a market that has dramatically repriced its expectations for Federal Reserve hikes. We saw that reflected in the Treasury market yesterday with huge moves in yields. What are you seeing in credit?
Oh, well, it's been interesting. I think we've seen credit measures jumping, credit risk measure jumping. Basically, investors are just jumping in on protection. The credit market can be a little illiquid in times like that, so investors flee to CDS because those are easier to trade. But I think this is a corner of the market that can be very vulnerable in this tightening cycle, just because there has been so much erosion in investor protection over the years. When times are good, easy monetary policy, investors just piled onto a lot of debt without asking too many questions or reading all the footnotes there. So there's, a huge pile of debt from zombie companies.
Good morning, traders. How are you doing today? I'm going to place an order for euro, and I'm going to buy euro at 104.55. So if you're looking to buy euro, you can place right now. We already purchased euro at 104.55. Right now, as you can see, the price 104.54.3. So you have your chance to buy at the lower level. Okay. In our case, we open position at 104.55. Okay, guys. Copy this trade. Stay with me. And I will guide you through this trade, and I will let you know what I'm going to do next with this purchase. Okay? Stay safe, guys.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
Futures in the green, but off of session highs after the S&P fell into bear market territory yesterday. Is the worst over? Have we seen capitulation? These are questions we'll pose to Art Hogan, Chief Market Strategist at National Securities, who joins us coming up next. This is Bloomberg.
nuestro estudio, nuestro experimento, no hemos pintado todos los edificios de blanco, sino estos más asequibles de pintar. Y ya hemos detectado reducciones medias en el área metropolitana de 0,8 grados aproximadamente en un periodo de ola de calor y con picos máximos de 4 grados de disminución en un momento puntual del día, en una zona puntual del día. Y como dices, en una ciudad como Barcelona funciona incluso mejor que las zonas verdes, según las modificaciones nos detectan incrementos, o sea, disminuciones de temperaturas mayores con tejados blancos que con incrementos de zonas verdes como tienen planteados el plan director urbanístico.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Okay guys, are you ready to trade Bitcoin? I'm placing an order to buy Bitcoin. The price I am looking to buy 280, okay? Order placed to buy at 22,280. If you're a Bitcoin trader, please place your order to buy Bitcoin. Okay? Okay, guys, stay safe, stay with me, and I'll speak to you after we will get filled with this order. I want to remind you that we trade on margin, so we trade quite large amount of money. 1% with Bitcoin equals 100 pounds. Okay, so if it will go to 1%, it will give us 100 pounds. Okay, I'll speak to you later, guys.
Yes, they were big losses yesterday for risk assets, but there's a driver, and for some at least, it felt orderly. We'll certainly get into this conversation in the next half hour of programming.
Yeah, absolutely. We'll be talking about that throughout, I think, the day for sure. Right now, let's take a look at what's going on in terms of futures preparing for the open. We are seeing a bit of a bounce after the big drops that we saw yesterday, the big drops that we saw on Friday. So futures up about 0.5%. And we also see yields coming back in. The 10-year yield got up to 337. Still, we're at 2011 levels at 331.61 on the 10-year, and that could be doing a little bit of tightening for the Fed. Speaking of, NYMEX crude continues to rise, 121.50 for a barrel of Texas Intermediate. I thought it was very interesting to watch this turnaround yesterday. We were down in the morning. And then came up sort of adding fuel to the fire, so to speak. No pun was actually intended, but that's pretty good. And then Bitcoin right now, 22,402. Remember, we've been watching this 30,000 level for weeks and weeks. Yesterday, it all came crashing down. Celsius stopping withdrawals, I should say, pausing, they say, withdrawals, definitely adding fuel to the fire there. But it'll be interesting to see what happens with the entire crypto space after such huge drops. Kaylee, what do you see in terms of the pre-market movers?
Well, I'm really paying attention to large cap technology, Matt, because as we know, the equity market literally cannot hang in there really when these stocks are down because they are such a large weighting within it. When you look at the likes of Apple, of Alphabet, of Amazon, of Tesla, they together along with Microsoft comprise something like 20% of the S&P 500. So when all of those stocks were down hard yesterday, that of course created a large drag on the broader markets. But as we see futures higher this morning, you are seeing these stocks also rebounding a touch. You have Apple, for example, up about 1 percentage point in pre-market trading after being down 3.5% yesterday. For Alphabet and Amazon, they were down about 4% and 5% respectively in the Monday session. They're each higher by 1% as well. And then Tesla is up 1.3%. It was the biggest decliner of those on the board here yesterday. It was down about 7 percentage points. And Anna, on a year-to-date basis, Tesla is down 39%. It has been absolutely brutal for these high multiple companies in particular as they face down the specter of higher rates. Of course, that monster move in treasury yields weighing on growth more broadly yesterday.
Yeah, absolutely. And that still seems to be the driving force behind US tech, doesn't it? We heard from Oracle, of course, a positive update there. But whether one company's statements and earnings can, I mean, it feels so retro, really, to be talking about earnings when there are such big macro themes in play right now. And that seems to be what's driving markets. Here, driving markets in Europe this morning, we're fading. We're fading as we go towards the lunchtime part of our day here in Europe. So mid-morning, I should say, not getting ahead of myself. Stocks Europe 600, then down by 0.5%. We were actually in positive territory at the start of, I get up early. We were in positive territory at the start of the European trading day, but we did manage to cling to that, and we see European stocks fading as we go through the day. Energy stocks getting a bit of a boost, bank stocks getting a bit of a boost as we price back in some moves higher after yesterday's selling. Certainly some Italian banks were beaten up yesterday, and some of those rebounding. The euro's interesting. We've seen a bit of a disconnect between what the euro is doing and interest rate differentials. It seems that in lots of parts of FX, thinking about the yen here, interest rate differentials are in the driving seat. But when it comes to the euro, it's fear around growth and fear about around fragmentation, as we now seem to call it, or potential for disorderly moves within the eurozone, potentially even break up within the eurozone. All of that seems to be front and centre, rather than what's been going on with interest rates and factoring in higher interest rates from the ECB. The euro, though, bouncing back from some of those losses of yesterday. The Italian two-year yield just completing the picture on what was a really turbulent time yesterday. This is where we yield right now on the two-year, 2.08. That's been moving fast, Matt.
All right, very interesting stuff. Right now, I want to talk about what we expect from the Fed in light of this inflation. Of course, that's really the cause of all of this market turmoil. Joining us to do that is Dominic Dwarf-Fricot, macro strategist at Macro Hive. Dominic, let me start with something that Jeremy Siegel suggested yesterday. I thought very interesting. The professor from Wharton saying if the Fed comes out with a 100 basis point hike, not only does that affect inflation, but also changes the narrative, puts Powell in control of the situation, and maybe markets would react positively to that. What do you think, and is it possible?
So, first of all, it's not very likely. The Fed has done what the Fed does when it wants to talk to market during the pre-meeting blackout. It's reached out to trusted reporters, and it's 75 basis points. It's not 100. Then the other things that I think market participants have not focused enough on is that there's going to be a big change to the SCP. That's, you know, some of the newspaper articles were about that the Fed, the administration made a mistake. They need to go for a much more ambitious hiking cycle. And I think the SCP is going to show unemployment above the long-term unemployment level. So basically, we're going to have a SCP that tells us more or less the Fed has given up on hopes of a soft landing, and that I think should scare markets quite a bit.
Yeah, so we will all definitely pay attention to that summary of economic projections, Dominique. So you say it's 75 that the Fed is realistically considering, because essentially that is what the market has given the Fed, to some extent, the permission to do. Do you think that the market would be happier to see a more hawkish Fed, in that it would mean that the Fed is actually going to do what it takes to get inflation under control? Powell would be more Volcker-esque, and if they're perceived as too dovish, that actually is a bad thing because it would mean inflation runs hotter for longer?
So the market would love the Fed to be able to promise that it can tame inflation without a recession. So 100 basis point, 150 basis point, no problem. The market would be very happy as long as unemployment would stay below 4% and growth would remain above trend. That would be fantastic. We would get an extraordinary rally. But unfortunately, and again, looking at this Wall Street Journal article, it looks like what we are going to get is probably an increase in the long-term rates of unemployment, and in the intervening period, the unemployment rate climbing above the long-term unemployment rate. So, you know, what kind of growth figure the Fed is going to put on that, I'm not sure. Maybe they will still show growth positive, but certainly they will have to show it below trend, below 2%. So if I was...
Dominique, sorry, just to sorry to interrupt there. Just to reiterate then, so you think the Fed is going to start forecasting, expecting a long-term increase in unemployment, and therefore, I suppose, giving us a sense of how far they are prepared to let unemployment rise so that they can tackle inflation?
Exactly. And you see, the Fed has a problem. It's the first time that they have to raise rates to tame inflation. I mean, in the previous two hiking cycle, it was more about normalization. There was no inflation issue. But they have to do it with SCP. So they have to tell the market what the impact of raising rates is going to be a few years down the road. And it's becoming, clearer and clearer that, first of all, we have a wage price spiral. Wages are going up due to higher prices, which makes sense with the low unemployment we have. So the only way to bring down wages and inflation is to have unemployment go above the long-term estimate. And I think that's what this Wall Street Journal article is telling us, and what we are going to find out when we see the SCP tomorrow.
Dominique, thank you so much for your time. We appreciate it. Dominique Dworfrico of Macro Hive, thanks for joining us to think about where the Fed goes. We continue to put the Fed in the spotlight. We'll talk next to Art Hogan, Chief Market Strategist at National Securities. What is he expecting from the Fed? And crucially, how will markets respond? This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
This week is fraught with peril. Inflation is really the Achilles heel of risk markets.
Markets are reacting the way they are because they believe the Fed is going to be forced to get more aggressive than they had expected.
I certainly don't think that a 75 basis point hike is out of the question.
Even though there might be an initial sell-off on 100 basis points, I think there'd be a subsequent rally because the Fed is finally getting hold of the narrative, which it certainly has lost over the last year.
This is a time to be selective, but I wouldn't sit on my hands.
There are opportunities in areas where one can position.
Pockets of stocks that have been proven.
Europe looks good to us. China looks good to us. The credit space in the U.S. looks good to us.
Equities in general, specifically in the U.S., I'm still pretty cautious here.
It doesn't have to be all about the U.S.
Because I still think we've got some wood to chop with respect to the macro and policy outlook.
Some of our top guests weighing in on the markets, Fed policy, and buying opportunities. Is there a dip buying opportunity in this market after the S&P 500 fell into a bear market yesterday? Let's ask Art Hogan, Chief Market Strategist at National Securities, who's joining us now up early for us. So, Art, for this to be a buyable dip, in theory, that would have had to be capitulation. That would have had to be the big washout that everyone says we needed to see in order for the worst of the sell-off to really be over. Is that what it was?
Well, I can certainly tell you that's what it looks like, right? So when the problem with everyone having their own definition of things like what a bear market means, and I would argue we've been in one for a long time, and what capitulation looks like. And I think when you put too fine characteristics or try to define that too succinctly, you miss opportunities like I think we're seeing this week. I think what we had yesterday was indiscriminate selling. Everything was for sale. Energy finally got around to being for sale. It's down about 10% over the course of the last 2 days. 500 of the S&P 500 were in the red for most of the day. Same was true for 2,000 of the Russell 2000 stocks.
Yeah.
So when you do damage valuations, this much multiple compression in a short period of time, and then have one of those days like yesterday where everything's for sale and you know, agnostic of sector or vertical, and that's what panic feels like. That's what the end of this cycle looks like, not the beginning.
If that's what yesterday was, if you're making decisions this morning, looking to put money to work, where are those specific opportunities that you see?
Yeah, I think the three best opportunities right now are technology that has earnings, right? So multiple earnings tech, some of the big household names that have seen massive multiple contraction in the near term, and I think that they've got defensible cash flows and moats. I think on the other side of that barbell, I would certainly continue to look at energy stocks. They're down 10% in a short period of time. They will likely have a long runway in front of them over the next 12 to 18 months. And the third is it's okay to be defensive and look at healthcare, and healthcare still trades at very attractive valuations. Those would be our three top picks if you're looking to stick your toe in the water today after the kind of damage we've seen through the course of the last 8 weeks and certainly the last 2 days.
Art, you know, I'm watching certain gauges to see whether or not this market really has capitulated. The VIX is one of those. It seems like it sort of slowly and steadily rose finally to above 30 yesterday, but wasn't in any kind of hurry. Another one is the put-call ratio, which we haven't even gotten to levels that we saw in 2018 or 2019. Right now, I think not even up to 1 yet. So why do you think these gauges and so many others are trailing?
Yeah, it's so interesting, Matt. Those are the two things that people are pointing to the most to say, hey, we're not there yet, especially the VIX. You know, for some reason, there's a magic number above 38 and getting closer to 40 where we believe, okay, that's it. There's enough people that are afraid that that we can get out of the water. And that, you know, that could well be true. But if everybody's watching this and defining the same points that you're looking at right now, whether it's the put-call ratio or the VIX, perhaps it never happens, and yet we could have a tradable bounce over the course of the next month or so. I just go back to the last Fed meeting, or 2 Fed meetings ago in March, where we sold off, you know, call it 15% coming into that meeting in a pretty straight line from January, February. March rolls around, we had the meeting, we bounced 10%. I think we're setting up for that kind of bounce after this meeting because I think the Fed's going to do something outside of consensus.
Oh, that's interesting. So what do you think the Fed is going to do? We just spoke to, our last guest was saying that, look, all of the talk, all of the newspaper and you know, Bloomberg and other outlets carrying stories that say 75 basis points is on the table. That, for her, was enough to say, look, the Fed's going to do 75. So what do you think is going to come from the Fed that's out of consensus?
Yeah, well, unfortunately, we get hung up with the fact that Chair Jay Powell said at his last meeting that 75 wasn't on the table, but neither was an 8.6 CPI. I think now that that's changed, he has the ability to say, listen, this is not flattening out, whether it's the CPI or the PCE. We need to get more aggressive here. I think the Fed funds futures have it right. So one of the next 3 meetings is a 75 basis point hike. It doesn't necessarily have to be tomorrow, but it certainly could be at 75 basis points or more back on the table and gets the market ready for this. So I think it's 50-50 that he goes higher than 50 basis points and certainly will in one of the next 3 meetings. One of the oddball things that he might be able to do too is add a meeting to August. Right now there's no meeting in August. They could actually propose that they're going to, August is going to be another meeting and give them another opportunity to front end load this and get back in front of the curve.
That would be interesting if he adds another meeting because it would break with the structure that he seems to stick to so rigidly, especially wanting to always warn markets ahead of time of any moves in a Burnsian way, right? Is this market waiting for a Volcker-like move?
Well, I think Jay Powell wants to sound as aggressive and deliberate as he possibly can. So I think there's some balance there, Matt. You bring up a really good point. I think he wants to say we're going to do whatever it takes to tame inflation, but we're not going to surprise you, right? And I think that there's a bit of a contradiction in trying to do. Right. Well, I think the surprise would be, hey, at the last press conference, I said 75 is not on the table. Guess what? Now it is on the table. And over the course of the next 3 months, we're adding an additional meeting. I'm not sure that that's startling.
Okay, so surprise guidance instead of a surprise hike, that could be the story. Art, thank you so much for joining us. Art Hogan, Chief Market Strategist at National Securities. Thank you for your time. Coming up on the program, Carrie Lam is optimistic about the future of Hong Kong. We brought you a short clip of our interview with the outgoing Chief Executive of Hong Kong. We'll bring you more of that shortly. This is Bloomberg.
Energy prices and a short supply of key chemicals that produce synthetic fertilizers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertilizer helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down. The manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
I'm a person who believes in relativity. So everything is relative. When people are opening up, and Hong Kong is still imposing a 7-day designated hotel quarantine, that to a certain extent weakens our position as an international city.
Carrie Lam, outgoing Hong Kong Chief Executive, speaking with Bloomberg a little bit earlier. You can catch more of that interview in the next hour of Surveillance. And for more of what's ahead, let's get to our single best charts. And Tom Keene brings us that, of course, as he does daily. Tom, I saw here in the UK real wages posting their biggest drop in 2 decades. That data out on the Bloomberg just this morning. You've got real wages in focus in the US as well.
Yeah, I saw exactly what you saw, Ann. And I'd also note as we speak, sterling down to 121.25 is going to break down a new sterling weakness here. There'll be an Anna Edwards donation coming up later on Surveillance today. And it is about real wages. It's about inflation-adjusted wages that we're seeing across all the deciles of America. My favorite is the ECI series, which is a combination of wages and those benefits we never take into account. They're very valuable. And the integram of the pandemic shows the good feeling of wage gains that we saw through the beginning of the pandemic, and we have plunged down like a rock. It is truly stunning to see where we are over 20 years.
Yeah, that is really stunning indeed. And also maybe makes us less worried about a wage price spiral, right? Nonetheless, Tom, before Friday morning, 350s felt big. Then all of a sudden, 75 was the outlier until yesterday. Now 100's the outlier. Who are the guests you're talking about today in preparation for tomorrow's big meeting?
We're going to review this, but I'm going to underplay it. Right now, it's all the rage. You know, Gina Smilik over at the New York Times is writing it up this morning. Our team is writing it up as well. You mentioned Jeremy Siegel, Matt, talking about 100 beeps. To me, it's going to be a set of people around the table at the Eccles building gauging this out. To have Carl Weinberg with us will be very good. He's got decades of perspective on a Fed that wants to maintain control.
All right, very interesting stuff. Carl Weinberg as well as David Rubenstein on with Tom. Bloomberg Surveillance up next, of course, Lisa and John. I think Kaylee in for John today. We're going to be watching a lot of data still today. The PPI, in fact, coming out. Neil Dutta writing on Friday that maybe the PPI is even more important than the CPI because there's so many components that are in the core PCE. Sorry for the alphabet soup, Anna, but basically the Fed is supposed to watch core PCE, or that's supposed to be its preferred gauge. Politically, it's very difficult to ignore headline CPI, but PPI may be important to PCE, and that could be important to the FOMC tomorrow at its meeting.
Okay, you just added more alphabet soup, but I take away your point completely, even though we do, of course, experience headline inflation, a point you've made many times, if we spent, of course, according to the basket. Let me tell you what's coming up here in Europe. We're focused, Matt, on something that might interest you. Isabel Schnabel at the ECB. She's going to be doing a speech later on talking about fragmentation, the risks of fragmentation, or will she? I mean, that's what we're being told she's going to be talking about, but they don't like to talk about it perhaps too much, and this is the big question. How much detail do you give about tools to fight what's called fragmentation? And how much do you hold back until it's actually necessary? And Matt, it's called fragmentation. I think we used to call it breakup risk back in the day.
Yeah, but now the idea is that it could push us the other direction. So fragmentation maybe is a better word? I don't know.
Yeah, maybe. Well, we'll see what Isabel Schnabel has to say on the subject of forging the Eurozone, continuing to forge the Eurozone. What tools does the ECB have, if it should need them, when it comes to fighting the spreads? That is it for this program. Surveillance is ahead. This is Bloomberg.
Okay, traders, as you can see, position opened on Bitcoin 22,280. Okay, stay with me. We opened, like I said, 1% equals 1,000 pounds when we trade Bitcoin. So it moved lower, a little bit lower. So if you want to trade Bitcoin, you can purchase at lower level. Okay, guys. Anyway, we're in. So I'll speak to you later. Stay safe. Okay, guys?
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management. It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Convinced the Federal Reserve is going to become more aggressive.
If they're going to do 75, it's better to do it sooner than later.
The Fed doesn't have much reason at this point to slow the pace of rate hikes.
For the next 6 to 12 months, things are going to be much more challenging.
We still think the base case is no recession.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. Thrilled you're with us on radio and television. Kaylee Lyons in for Jonathan Farrow in Capri. Thank you for your response to what we did yesterday. It continues today. And I love, Lisa, all the little tea leaves. We'll get to those in a moment. Hartnett over at Bank of America saying, look forward to the summer of Volcker.
And are we there yet with respect to the cathartic puke, or is this the beginning of the summer of Volcker?
Puke, they were such
and
a
how
good
much?
band.
I mean,
I loved what they did.
Well, but this is really what people were talking about yesterday, and the lack of understanding in some of the notes on Wall Street as to what was happening. Was this just a lack of buyers? Was there forced selling? When did the margin calls start? When do we see something break?
You know, that night, Kaylee, where cathartic puke played at UVA, the night they beat Duke, and they were thrown off Kansas. Where did this language come from, Kaylee? It is so unladylike to call it a cathartic puke.
But
it's
it is
not.
a great band
It's
name.
called a bear market.
I'm all for that. Well, it is a bear market, and that begs the question, Tom, of now that we've fallen into a bear market, is the dip buyable, or have we not yet seen that kind of capitulation that you actually need? And while you saw futures higher, they're well off session highs. We're only up about 0.4 on the S&P 500, so it isn't that much of a convincing rally this morning.
Lisa pulled an all-nighter on her morning brief. We're going to get to that in a moment. But, Lisa, I want to frame out the tea leaves I see right now. BitDog can't get a bid. It really had an ugly last 12 hours. Just moments ago, pound sterling broke down again to new weakness, a 121.10 there. A 119 sterling would be unimaginable. And I'd also point out, Lisa, maybe what matters, and it's your bailiwick, and that's a 2-year yield.
Yeah, 2-year yield coming off the highs that we saw yesterday since 2007. Real yields, I'm watching those because real yields on the 10-year rose to the highest levels going back to 2019, almost 0.7% at one point yesterday after being negative just a couple of months ago. Taking a look more broadly, you're seeing a little bit of a reversal, but again, is this conviction buying? Where are the convicted buyers at a time?
There's no conviction buying today.
Right, but I think that that's important to know at a time after one of the worst sell-offs that we have seen in a long time, a solid bear market.
I'm going to do a data check in a moment. Kaylee, what are you observing this morning different from yesterday?
Well, at least there are some gainers I'm looking at underneath the surface of the equity market, because we have to talk about the breadth of yesterday's sell-off as well. No one was spared, not even energy, which has been the ballast, the only outperformer within the S&P 500. Energy stocks were down among the hardest declines yesterday. Only 5 stocks in the S&P 500 managed to end the day in positive territory. The breadth of the selling yesterday is more turning into breadth of buying this morning.
We look at equities, bonds, currencies, commodities. We start with the VIX 33.61, nicely elevated over that 30 level. A number of guests yesterday saying we need a cathartic move to 40 to really get it done. It hasn't happened. Futures bounce up 11, Dow futures up 61 as well. In the yield space, Lisa mentioned 2-year comes back, 30-year bond 3.31%. 2-10 spread is all over the place. Curdy's got a great chart on that we'll look at later. It looks beautiful on radio. Oil, I think, is underplayed. 123 off of Libya intentions there on production, 123.12 on oil, $1 below recent highs as well. Gold can't get out of its way. Dollar stronger. DXY over 105 is very important right now. I'd note Euro 104.34. Swissy doesn't really get out of the way with Euro. That's about it right now. I don't think I can say much more. We need a brief. We need to calm down and have a brief.
I want to just say, we are watching regime change. I was looking at negative yielding bonds and the total volume outstanding. It has fallen to the lowest since 2015. We have revoked the era of low interest rates in the face of higher inflation. The latest on that higher inflation, 8:30 a.m. U.S. PPI for the month of May. Neil Dutta over at Renaissance, as Matt Miller has been talking about, calls this more important potentially than CPI. The reason why is because it could indicate how much more pricing power or lack thereof companies have. How much more margin pressure do we see? You subtract PPI and then CPI and you see what you get. Right now, we're looking at an actual reacceleration because of food, because of energy prices, and that matters, even though a lot of people try to strip it out for some more consistent measure. At 11 a.m., President Biden is trying to shift the message again, talking about labor, speaking at the 29th AFL-CIO Quadrennial Constitutional Convention in Philadelphia, Pennsylvania. Can he shift it away from this story, which is gas and all gas, moving to a new all-time high, well above $5 a gallon on average across the nation? How does he get out from under this? And how does the Fed get out from under this, considering what it is doing to sentiment and what it is doing to longer-term expectations, the kickoff to that two-day meeting in Washington, D.C.? We're not going to play the Fed parlor game all day, although you might hear it in other places. I'm doing this for you, Tom. People talking about possibly a surprise 75 basis point rate hike at this meeting. My big question of the day, frankly, Tom, is will that be positive for markets or negative for markets if they surprise with a more hawkish move? And right now, that 2-10s yield curve, the flattest that we've seen. Yes, there have been periods briefly, but this to me tells a story of possibly stagflation or recession. And does the Fed care about this? Do they want to manage this? Or is it all about sending a really strong message to markets?
In a flighty yield curve as well. I'd say it's just bouncing around a lot. Let's get to conversation here, and that's where we'll address what the Fed's going to do. Look for our special tomorrow. I've got a great set of guests lined up. We start strong. Matt Luzetti will join us from Deutsche Bank for our Fed special tomorrow. And, of course, Deutsche Bank out with a recession call out in the distance, which right now looks on the edge of pression as well. Always prescient. At Federated Hermes, Linda Dussel joins us there, senior equity strategist. Is your team under the desk? I mean, Linda, you know, are people hiding under the desk this morning?
I have to give my team credit because when we started this year, we said that we thought you'd see a lot of volatility and that cash might actually be king. It was the first time in my career at Federated Hermes that neither the bond representative nor the stock representative was very excited about their areas. So I think we're going through what we thought we would do. In our conversations at the office, we're saying that this is going a lot quicker, though, than what we thought.
Linda, is this it? Is this the cathartic puke? Tom accused me of not being very ladylike, but you don't want to buy when people are scared, and yet here we are, and that typically is the best time to buy. Is this it?
No, I don't think it's it. I mean, we see what's happening in the crypto. Crypto's having their puke, that's guaranteed. But I'm still seeing and hearing too many buy the dip ideas. We only came down 20% on the S&P, and I guess we tested it once here with a quick 10% bounce on really pretty poor volume. But I don't see why we shouldn't do even more damage than that. With all the money that was pushed into this system, so many people buying up, so many assets out there, and that does have to be wound back. And I think it might end up being probably a recession and probably maybe a couple of hundred more points downside on the S&P.
Linda, Lisa raised this briefly, the idea that now the market is kind of giving the Fed permission in some sense to move 75 basis points, or at least it wouldn't be all too surprising. Would the greater downside risk to equities be a Fed that acts too aggressively, is too hawkish, or is too dovish and there's little faith that they're able to rein in inflation?
Yeah, I think, how it works out, we're not so concerned. I think a 1% move would be a big shock, just a big shock to the markets. The 75 basis points versus 50 basis points. I think we're kind of in this situation that says, whatever, they're going to keep on going. We find it interesting. Very recently, the betting out there for the Fed terminal rate is now up to almost 4%. So where we end this is very important. And if you're talking about the PPI, how PPI and CPI particularly come down, because we saw the M2 money growth peak in February of 2021, and historically about 13 months later, the CPI, the core starts to pull back down, which you might say it did a little bit in the last 2 months. So it might come down fairly quickly. I'm not betting on that right now, but that's what we really, really have to watch. And the Fed will just keep going on and being data dependent. And then QT is just a big mystery to all of us.
Well, Linda, you mentioned PPI, which raises the question of input costs and margins. Are margin estimates still too high for the rest of this year?
Yeah, that's what we're particularly concerned about is, as the news coming out of Target was that like just the tip of the iceberg as to what might come next, and might more and more industries have to report, even if they had a good second quarter, that their outlook is that margins will be squeezed, because to date it was all PE multiple contraction. And if we start to pull down our earnings estimates, that's going to be a double whammy here for the market. So it could be a tough couple of months here.
Linda, thank you so much. Greatly appreciate it. Good perspective to get us started this morning. Lisa, I want to go to Europe as well, where we've got German yields out. We always look at them. And then, as John Farrow does, we look at Italy and I look at the DAX as well, but the Italy piece, and it is breaking out to new wides this morning. And Lisa, an underplayed story, I thought Zero Hedge did a great job on this last night, is the ebbing away in IG and high yield credit spreads. What is that velocity right now, Lisa? How wide are they going? How fast?
So for a lot of the sell-off that we saw this year, credit held in pretty well. No longer. The sell-off has actually accelerated at a pace that we have not seen going back to March of 2020, if you take a look at both investment grade and for high yield. And the average yields that you're getting are things that we have not seen going back years, particularly in the investment grade space. You're looking at nearly 5% on average for the all-in yield, which is actually what high yield was yielding not that long ago. This is a complete repricing. That's why I say this is a regime shift, Tom. How do we readjust? And when do we start to see things break down a little bit more? Or is this going to be orderly?
In 20 seconds, Lisa, one of the issues is we're readjusting with a near 6% mortgage rate. Julia Coronado featured that yesterday. All of a sudden, boom, 6%.
And it is starting to slow the sales. People are saying that it might not slow the actual purchase price to the degree that people expect just because of a dearth of a supply. This is a real big question. What does it do if you do get a housing market?
I think it's one of the mysteries.
It's one of the many mysteries of the market. I will say one of the other mysteries is what happened yesterday.
It's different than yesterday, folks, but I really want to emphasize there are certain tea leaves moving. Sterling, 121.09, my attention. Bitcoin can't get a bid, 22,300 as well. Please stay with us with more data checks today on Bloomberg Radio and Bloomberg Television. Good morning.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. President Biden will travel to Saudi Arabia in July and meet the country's de facto ruler, Crown Prince Mohammed bin Salman, according to an NBC report. No immediate comment from the White House. Biden once promised to punish Saudi Arabia over its human rights abuses. The possible trip indicates his drive to lower gasoline prices and isolate Russia over its Ukraine war. Two Wall Street banks are withdrawing from handling trades of Russian debt. The Biden administration said last week it's banning U.S. investors from scooping up such assets. J.P. Morgan Chase and Goldman Sachs were still matching sellers who wanted out of the debts with buyers. The U.S. Treasury's Office of Foreign Assets Control says U.S. investigators aren't allowed to acquire them. The spending power of UK households fell the most in more than 20 years as wage increases were eaten up by the fastest inflation in decades, according to the Office for National Statistics. The figures show how pay for most workers is failing to benefit from the tightest labor market in living memory. And Hayes Fan, a member of Bloomberg News' bureau in Beijing, was released on bail in January, according to the Chinese embassy in D.C. It's been more than 1 year since she was detained on suspicion of national security law violations. Fan's case is said to be under investigation. Bloomberg editor-in-chief John Micklethwaite said, quote, "We will continue to do everything possible to help her and her family." Hong Kong residents will have to show a negative COVID-19 test result to enter the city's bars and nightclubs starting on Thursday and running through the end of the month. The decision comes as the city is seeing an increasing number of infections, in many cases driven by transmission at entertainment facilities that recently reopened. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
Everyone you meet in Port Harcourt has stories about what they call black soot, caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes, have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now. We are dying slowly but surely, and our lifespan is reducing every day.
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
says a 50 basis point hike is coming.
The Fed is telling the markets what it wants them to do.
But what's next?
Some big questions about the next move, the one after that, and ultimately the destination.
Maybe they can let the high prices naturally bring down demand.
Trust Bloomberg for the fastest coverage and exclusive analysis.
The press conference live. McKee in there. It'll be interesting.
Bloomberg surveillance. The Fed decides. Wednesday on Bloomberg. The fastest way to stay one step ahead.
They've already said, 50 in June, 50 in July. Given how bad the announcement was Friday, I think what Chairman Powell can do is bring that 50 forward. Even though there might be an initial sell-off on 100 basis points, I think there'd be a subsequent rally because the Fed is finally getting hold of the narrative.
The pundits out in force on the mathematics that we will look at tomorrow afternoon. The Federal Reserve, Lisa and I and John and Kaylee Lyons, we're going to ignore a lot of that punditry and guesstimates because all that really matters is what the chairman, the vice chairman, the governors and the presidents decide around that table at the Echo building. There are other tables in Washington, lots going on with the president in Washington. Anne-Marie Horton joins us now, our Bloomberg Washington correspondent. Anne-Marie, Greg Vallier makes really clear things have to change, this malaise at the White House. Define the malaise that you see from that beautiful camera perch you have across the green lawn near Lafayette Park.
Well, I think we saw it in the beginning of the month, right? The administration wanted to make this concerted effort to talk more, at least from a policy and communication of their policy point, about the economy. They obviously are getting hit hard in the polls about the economy. Inflation is #1 top concern of American voters as they gear up to go to the polls in November. And that's what they're trying to do. But of course, the issue is there's so many levers only the president can really pull when it comes to trying to tackle inflation. He's going to be talking about the economy today with the AFL-CIO. So this is going to be obviously about labor. We know the White House said that they're going to talk about building the economy from the middle class out. It's something the president likes to talk about. But if they're not going to change any sort of policies, we're still waiting on things like the China tariffs, then it is a sense that it's a continuation of that malaise.
And part of the tackling of inflation may be a trip by President Biden to the Middle East, to Saudi Arabia, to meet with Mohammed bin Salman, the Crown Prince. And the trip by NBC, this is being reported by them, would be from July 15th to July 16th. What would he be hoping to achieve in that meeting, ideally, that could help bring inflation down?
So two things. This meeting would likely be alongside other Gulf members from the GCC, and right now Saudi Arabia is the country that has the presidency. It would also likely mean that Biden would have a meeting or would shake hands with the de facto ruler right now of Saudi Arabia, which is the Crown Prince Mohammed bin Salman. So it's tricky politically, right? Because we all know what the president had said on the campaign trail. He wanted to make Saudi Arabia a pariah state, and now he would be going into the kingdom and setting foot on that soil. It also comes at a point, though, that the administration has been recalibrating in a sense, and a lot of capitals around the world have. How are they going to deal with diplomatic issues? Many allies are potentially frenemies that now for some other people are becoming allies. I'm not talking about Saudi in general. I'm just talking about in general because of the war in Ukraine. So you do have a shift in the administration on wanting to engage more with the kingdom. And also part of this, of course, is the price of gasoline. We're now north of $5 a barrel, a gallon on average. But we should note that Saudi Arabia, while they do have spare capacity, it is not enough to save $5 gasoline in America.
So this ultimately, Anne-Marie, is just about the optics being seen trying to do something about high oil prices.
Right, but the trip is not just going to be about energy. I mean, we've heard that from the White House, from the press secretary, but also people I'm talking to. There's a lot of other deliverables that this trip would have. So this would be energy, of course, but also security in the region, things like defense in the region, economics, climate ambitions this administration has, which of course, Saudi Arabia, we do know that the Crown Prince has been trying to diversify his economy. We saw that just last week with obviously them taking on this brand new golf tournament.
Right.
This is something that the kingdom is trying to do, and so there'll be a breadth of issues that will be discussed.
Emery, can we break OPEC Plus? Is there a belief within the international relations zeitgeist that Mr. Biden or America or the allies can break OPEC Plus?
Well, the thing with OPEC is that even before Russia invaded Ukraine, OPEC itself, countries within OPEC have had wars at each other, and still the cartel has still lived to this day. So there is a lot of talk always about the death of OPEC and the death of OPEC Plus. But what the Saudis were able to do at the last meeting, being the de facto leader of this cartel and this group, was really walk this very fine line with giving an olive branch to the administration that since August has been asking for more oil, at the same time keeping Russia on board to agree to this increase in production. How long are they able to do that?
Right.
That's really the question.
Emery, thank you so much. We've got to go and look at the markets. Emery Horton in Washington this morning. Lisa Bramowitz, just moments ago, sterling, a 121.00, one indication of slowing economies in continental Europe.
And that comes after that labor market report that showed that real wages in the United Kingdom, kind of like in the U.S., fell to their lowest going back 21 years at least. Basically, inflation is eating away any gains people are seeing in terms of wages. This just speaks to the moment we're in. Also, just moments ago, Tom, I want to point you to this. The NFIB survey of small business optimism came out at its lowest reading in history, in its 48-year history, in terms of what small business owners expect over the next 6 months. This just sort of underscores this feeling of doom, both with respect to markets, but also in the real economy.
Yeah, I saw the report last night, embargoed, and I thought Bill Dunkelberg's report was incredibly nuanced, Lisa, about just the battle small businesses having pressed by inflation, and yet still that impulse, they can't get people to work.
Well, and so at what point do they stop trying to hire them? And this, I think, is what a lot of people are
indications
talking
of that
about
yet?
that. No, not at all, which is potentially problematic because people want to see that to release the pressure from some of the price increases. But without price increases, people have that much less to spend on an inflation-adjusted basis. I mean, I know we don't want to play the Fed parlor game, but how is the Fed going to get ahead of this if they don't make a big move at this meeting and recognize, yes, we're seeing pain, and the response is opposite to what we otherwise would have done, say, a year or two ago?
You're cathartically pressing my buttons because you know I believe no central bank ever, quote unquote, gets ahead of this. I mean, Kaylee Lyons, when you're studying,
pushing his buttons. I like this. I'm going to try to do that as much as
Everything
possible.
is cathartic.
Yeah.
Yeah, Pharaoh's not here. You can do it.
Button pressing.
Kaylee, I mean, this is like you're learning monetary history, freshwater history at UVA. I mean, the bottom line is central banks don't get ahead. They're data dependent, right?
Yeah, and they're following these markets, and the markets keep pushing them farther and farther, Tom. We now see even odds of a 75 basis point hike tomorrow. That is what the market is pricing.
That's what the market's pricing. We will
Lisa
wait
and I
and
can
see.
both play the cathartic button pushing game, Tom.
You know what? Let's go.
Well, good. Piling on, Claudia Sam will join you. We are thrilled to bring you Claudia Sam on this moment for the markets. Futures fade.
companies know they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Good morning, everyone. Bloomberg surveillance on another day of market turmoil. We're going to do more data checks here right now. Lisa, I just note a 120 print on sterling as well. What do you see, Lisa, that sticks out right now?
And if you take a look at the tape and you look at the cross-currency pairs, a lot of that has to do with the dollar strengthening and ebbing away some of the weakness that we saw earlier in the morning. And this comes along. I mean, actually, if you look at DXY, it just broke out positive here. So we had seen it weaker versus peer currencies. Now it's stronger. We're looking across the board. We had seen stronger gains. They are fading the S&P up nearly just a tenth of percent. But also that 10-year and 2-year yield, we actually saw buying come into the bond sector.
We may get an inversion any moment, right?
Is fading. And I really am watching that because at that point, the rate fear is not over.
It's a different character than yesterday, folks, but I really want to make clear there are little tea leaves here, including Italian paper moving out and the Italian-German spread moving out to new widespread for Italy. Right now, and this is a treasured moment, if you go to Fred, the St. Louis Fed iconic database, there is the SOM rule. It would be good to speak to Claudia Somm about her rule, the SOM rule, which is a wonderful zero BS formula saying, wait, let's look at jobs and guess the recession. We get away from the Fed parlor game with some real economics. Claudia Somm joins us today from Somm Consulting. Claudia, real simple here. The job market says there's no recession, right?
Right, that's correct. We have a really strong job market. Lots of demand for workers, lots of jobs.
Do you see any indication that the market turmoil that we see, the financial system can go over and amend the job market?
Right, well, what we're seeing both in financial markets and what the Fed is doing in terms of raising rates, they both have the ability to depress demand. How much consumers are willing to spend in the United States, consumers are the engine of growth. If they start spending less, there's less need for workers, and it could lead to layoffs. And that indicator, the SOM rule, is all about watching the unemployment rate creep up. And that's an indicator we're in a recession. So that's what we're looking for. And honestly, it doesn't have to be a lot of weakening.
Claudia, where are we, considering all the fears of recession right now? Where do you think we are?
Right. Well, I feel really strongly that we are not in a recession today. Again, the labor market is really strong. If you look at consumer spending, people are out there spending, right? I mean, that's part of why we have the inflation. People are still spending a lot. And so we're not in a recession now, but that should be no comfort necessarily that we won't end up in one. And frankly, what we're seeing in the last, several days is what could easily turn into a self-fulfilling prophecy of spiraling down expectations, both in financial markets and also potentially among consumers. We need to see things cool off some. Again, on the demand, that's the tool the Fed has. But if we cool off too fast and too much, that's where we end up in a recession.
Claudia,
and those can come quickly.
We've heard that from a number of people, that it's the media or people who are coming out and saying, oh, look at how terrible things are, and then people get scared, and then the inflation expectations go up. However, if you drive down any highway and you see the gas prices climbing as quickly as they are, if you go to grocery stores and you see how much higher your bill is than it was before, if you take a look at that, real wages in the United States on a weekly basis are negative 3.9%, the weakest in a long, long time. How do you get a sense that this is going to be positive for consumers than it's just a messaging problem?
Yeah, no, I don't think this is a messaging problem. I do think in the consumer sentiment, we saw really low numbers, not like Friday, but we saw numbers really head south on consumer sentiment last year around this time. And that coincided with gas prices really starting to take off. Gas and also food, gas in particular, just looms really large in how consumers think about inflation. It's the price they see every day. They don't need the media to tell them what gas prices are. What is difficult is that it's really hard it's really hard for the Fed to get food and gas prices down. And that's what people are really concerned about, because we need those. Those are more necessities. That is a supply side problem. That's not the Fed's problem. I mean, it is their problem right now because they're about inflation. But that's one that we shouldn't be promising consumers a lot of relief by the Fed raising 75 basis points, 50. Like, that's just not where they have the lever.
Yeah, it may be a problem for the Federal Reserve, but that doesn't mean that the Federal Reserve is inherently the solution, Claudia. Obviously, it's not just about rate hikes. It's not just about QT. We're also going to be looking at that summary of economic projections. I was speaking to a guest from Macro Hive earlier, Dominique Dworfer-Co, who basically said the SEP is going to show that the Fed has given up on a soft landing. Do you agree?
So I don't think the Fed is going to give up. I think the one lever the Fed controls, and what I'm looking for in the SEP, is how fast do they want to push this to get inflation down, right? If they were really pushing, and the past SEP didn't say it, like if they wanted 2% end of this year, early next year, then yeah, we got a recession because they got to turn the screws.
I'm so happy, Kayla, you brought this up. Claudia, there's more Fed pontification going on right now than anything I've seen. No one's read Bernanke. No one's read the wonderful Alan Meltzer. Nobody's read Richard Timberlake and the Georgia School as well. Claudia, stop. Can you explain to all the Fed pundits ventilating, including to Kaylee Lines, can you explain that central banks are always ex post and data dependent? Do I have that right?
Absolutely. They are data dependent. And this episode, the data that we are dealing with right now are fundamentally different than what the Paul Volcker Fed was dealing with. And I think, yes.
No, but Kaylee, I think this is really important. There's a lot of ventilation going on, and I get it. People are scared of VIX of 33. You know the numbers better than me, Kaylee. The bottom line is adults like Claudia Sahm are saying they've got to wait to see the data.
Yeah, fair enough. And I'm glad we have Claudia Sahm here to talk about it because, as you say, Tom, there is just so much murmuring going on as investors try to figure out what exactly they are supposed to do with their money. And, of course, investors are also looking ahead to that producer price inflation data later on this morning. Claudia, are you in the camp that that is actually more important than the CPI data was because more components of that feed into PCE, which is what the Fed is really looking at?
Yeah, so the Fed isn't going to hang its hat on some nuance that the couple series that the PPI informs PCE are the ones doing well. I mean, the CPI was uniformly a bad read on Friday. Now, what one could hope for in the producer price index is we're starting to see some easing on the prices that are going into businesses, the kind of prices they're passing on. Because at the end of the day, though it is not talked about a lot, we have some very serious supply disruptions from COVID and from the war in Ukraine. And we need to see, to avoid a recession, we got to get some help on those pieces. It's not looking real
Claudia,
encouraging.
Claudia, when we talk about data dependency, we are looking at data we have not seen in 40 years. We are looking at data that is potentially catastrophic for the lowest income in the United States and frankly around the world. At what point do the Fed respond to this data that we're looking at right now rather than parsing out the nuances and just take a look at that and say, we act big, and that is what our job is?
Yeah, so Fed Chair Jay Powell was very clear recently. They are looking for clear and convincing signs that inflation is coming down. Right, this is not about jobs right now. Maybe they do, say, hey, we're going to give up some jobs, unemployment will rise. But really, this comes all down to what does that CPI look like? Are we really making progress? They got burned last year. I did too, on thinking that COVID disruptions would ease and that would help bring prices down. That wasn't the case. The data are too hard to parse right now, the little moving pieces. So it's just all eyes on the big number.
Claudia Sahm, thank you so much. Dr. Sahm, of course, Sahm Consulting here. And the Sahm rule, I really urge you to study it if you're part of Global Wall Street, linking in job dynamics into the recession. Call Lisa the tea leaves right now. I've got sterling 121.07. I'd also note the Italy-German spread, maybe one of the litmus papers of Europe, has just widened out to new width here. The distance between Italy and Germany ever wider.
Yeah, ever wider, back to levels that we saw during the peak of the pandemic in 2020. But if you take a look at an absolute level, Italian 10-year yields higher than 4% at this point. That's the highest going back to 2014. We're looking at new levels that we had not seen in years and had not imagined. Is this what the ECB wants? At what point do they come in with some other program, or do they allow this spread to gap out and allow some of the euro existential crisis that people are wondering about that could potentially raise some, I don't know, discomfort among the member states?
And Kayleigh, to be honest here, with futures up 12, it's not that large of a bounce off negative 700 Dow points yesterday.
No, it's not convincing at all. Obviously, futures were up much more earlier on in the futures session, but we have now given back a large majority of those gains, at least when it comes to S&P E-minis. Not a convincing bounce at all, which raises the question of whether or not we are done, whether or not the worst is over. If yesterday was really the cathartic puke, ladylike or not, that is something you could call it. Capitulation, whatever the term is that you want to use, Tom. People are looking for that chaos, that forced selling, that ripples across the market. Was that it yesterday? I don't think we have an answer to that question.
Yeah, I got a wonderful email. Michael, thank you so much for listening in Austin, Texas. Cathartic Pukes playing Cheers Shot Bar down in Austin Friday and Saturday this weekend. Just if
Tom has tickets.
If anybody's interested.
He's playing.
And again, as Anne-Marie said, as we continue to monitor these markets, Lisa, I'm sorry, the elephant in the room is oil just has not given back. There's a global slowdown. Oil's supposed to go down, not.
Yeah, and that's what people are looking for. But even if oil prices come down, is that really going to change the price of a gallon of gas? Because refineries have been in short supply, and that's been a huge issue. It doesn't seem like the input prices are going to come down all that quickly. We had a crisis upon crisis. We had Ukraine and the war that Russia waged. We had the shutdowns in China following the pandemic. How do we model this out? How does the Fed parse out nuance in a very unnuanced inflationary headline number?
Stay with us through an eventful morning, including business inflation, the PPI series as well. The dollar, DXY 105, Mark McCormick in the 7 hour. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. President Biden, in an Oval Office meeting last week with key members of his cabinet, indicated he's leaning towards removing some products from the Trump administration's China tariffs list, according to an Axios report. With inflation at a 40-year high, the Biden administration is looking to show action on bringing down those prices. Beijing has reported the highest number of daily COVID-19 cases in 3 weeks. 74 infections were reported on Monday. That is the most since May 22nd, when the capital hit a record for the current outbreak. The nation's top official for pandemic control, Vice Premier Sun Chunlan, is urging Beijing to control the outbreak as soon as possible. Hong Kong's lobby group for fund managers is urging incoming Chief Executive John Lee to scrap quarantine rules for travelers. The Hong Kong Investment Funds Association says the city needs to restore its status as an international financial center. The body represents firms with more than $52 trillion in assets under management. And the spending power of UK households fell the most in more than 20 years as wage increases were eaten up by what is the fastest inflation in decades, according to the Office for National Statistics. The figures show how pay for most workers is failing to benefit from what is the tightest labour market in living memory. Hot, dry and windy weather is challenging fire crews from California to New Mexico, with wildfires forcing hundreds of people to leave their homes. Roughly 2,500 homes have been evacuated because of two blazes on the outskirts of Flagstaff, Arizona. The high winds have grounded firefighting aircraft. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
The Indian city of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani. His company Reliance has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the Indian government's plan to reach net zero emissions by 2070. But Ambani is not alone. India's second richest man, Gautam Adani, has committed $20 billion of investment.
Okay, ladies and gentlemen, it's time to place stop for Bitcoin. Okay, let's place stop loss for Bitcoin. The price I'm looking to sell at 22,392. Okay. 22,392. It will give us 0.5% in profit. What it means? It means that 392. It means that we will make £500. Okay. So place your stop if you decided to copy this trade. If you decided to follow me, and let's see. Let's observe. Let's follow this price. Let's see if it will move higher, we will increase our stop loss. If it will move lower, we will close position and we will re-enter position at lower level. This is how simple is this. If you want to get this strategy, please go to companyeye.co.uk. Otherwise, stay with me and I'll speak to you later.
Really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Why do the biggest names in business choose Bloomberg?